But it seems already we aren't even at day one yet. He's still assembling a team, and they're already benchmarking themselves to this equity market.
Of course, there's everything else we need to look forward to this week, potential catalysts. We're going to hear from Fed Governor Christopher Waller today, and then tomorrow we're going to get the latest inflation data.
Yeah, and we've got the bond market. The cash bond market has come back. It's come back with the bears in charge. We're offered down in price and bid up in yield on the very short end of the curve. And it's ironic because that flattening of the curve that we had last week, Danny, post the election, and the drop in yields net over the week, it allows a re-attack on the upside on yields at the start of this week ahead of some of this Fed commentary. I had a conversation with Kathy Jones from Charles Schwab. She was saying 5% for her is actually a reasonable fair value. Why? Because you raise up that terminal rate up to around 4% and you add in your term premium.
But if you hit 5% on a 10-year yield, can you actually still continue to see these small caps trade in the way they have? Let's take a look at where the markets are trading this morning. As we've said, they're pulling back slightly, but the Trump trade still has that momentum in it. We do have S&P 500 futures hovering around that 6,000 mark. Manis has been talking about this all morning, this quest potentially for parity in the euro dollar. We have seen a much stronger dollar when it comes to the reemergence of a Donald Trump president. 6 basis points now higher on the 10-year yield, and New York crude 68.55. Higher yields, that is taking, and a higher dollar, that means lower oil. Also, this concern about lack of demand coming out of China. Also, when it comes to just the broader equity market picture, JP Morgan talking about in a note that it expects 2024 returns to be larger than 2016. The Trump trade continues, even if we are seeing it pull back just slightly. Coming up this hour, Richard Bernstein of Richard Bernstein Advisors. This is investors worry the rally looks overdone. Well, let's see. Former New York Fed President Bill Dudley on the push and pull between Trump and Fed Chair Jay Powell, who we'll hear from on Thursday, and Sonia Meskin of UBS looking ahead to CPI and PPI. We begin this hour with stocks on hold as markets re-examine the potential impacts of Trump policy. Richard Bernstein of Richard Bernstein Advisors saying it seems highly unlikely that the new administration will exhibit fiscal prudence anytime soon. Tariffs might be an effective trade tool when there is domestic production to protect. However, the U.S. doesn't have nearly enough production to meet demand, so tariffs should be viewed as an inflationary tax because there aren't domestic goods to substitute for the tariff imported good. Richard joins us now. Richard, thank you so much for your time. So when you look at potential Trump 2.0 versus Trump 1.0, what are you expecting from this administration?
So I think right now it's pretty easy to figure out, right? We have a very accommodative Fed. We have a Trump administration that so far doesn't seem to be focusing on fiscal prudence. So if we have stimulative fiscal policy, stimulative monetary policy, we should expect nominal GDP to be stronger than people think, and therefore the stock market and corporate profits will respond accordingly. So I think that's what's going on. I think, you know, my general theme, regardless of whether President Trump is there or whether it was a President Harris, our general theme was that people should expect more inflation rather than less, Richard, based on just the notion that globalization is contracting.
Putting all of that together, is the Fed then making a mistake by maintaining an easing bias, if that is the trajectory we're on?
Well, one has to be careful about, you know, like the Fed's not calling me up and asking me my opinion. So whether I think they're making a mistake or not is probably irrelevant. But I will say that this is highly unusual, that the Fed is cutting rates into an accelerating profit cycle, right? Profits tend to spur employment. Profits tend to spur CapEx. And so normally you would find that the Fed is hiking rates into an accelerating profit cycle. Right now they are cutting rates into an accelerating profit cycle. That's putting fuel on the fire, which I think supports the notion that people should be expecting more inflation rather than less.
Richard, let me just say, I don't know what the Fed thinks or who they want to seek advice from, but we want to know your opinion. So I'm glad you gave it to us. I also know that your fixed income portfolio at the moment remains shorter duration than the benchmark. Just how concerned are you about a rise in higher end yields, pain in duration with those fiscal concerns coming online?
Yeah, well, I think, you know, that's been one of our central themes, is to be shorter duration than the benchmark because of stronger nominal growth. Really, that's really it. But on top of that, I think one thing that investors really haven't paid enough attention to, and we've written about this extensively, is the United States has been penalized for 11, 12, 13 years now since U.S. debt was downgraded. U.S. Treasuries have consistently sold at a higher yield premium versus AAA-rated sovereigns from other countries. Remember, the United States isn't AAA anymore. So if we saw a downgrade in munis or corporates or anything, we would expect there to be a risk premium attached to it. That has occurred and has been going on in the United States. So there's not going to be a day of reckoning the way people like to talk about. It's more like a slow bleed, and that slow bleed has been going on now for 13, 14 years, sucking capital away from the United States, sucking capital away from productive use.
So does that reverse, Richard, good morning, does that long, slow drain under Trump too, do you think that, I mean, one of his ambitions is to regain market share of manufacturing, but do you think that that slow drain of capital inverts and comes back? And what is the impact on that? Because that presumably is a dollar asset positive.
Right. So it's a question, I mean, of fiscal prudence, right? Do we want to raise revenue? Do we want to cut spending? Those are going to be the big things. And part of this is, do we want to reorient capital in the economy to productive use? I mean, look at what's going on right now with cryptocurrencies. I'm not the biggest fan of cryptocurrencies. It's very hard to argue that that's an allocation to productive capital. Like, what does it do for the economy? It doesn't do anything, as opposed to putting it into manufacturing and things like that. So I think we have to be very careful about the notion that everything's going up. We really want it to be oriented towards productive use in the economy.
Okay, so everything's rising at the moment. There's a certain amount of unbridled euphoria in these equity markets, and they're not really looking at the bond markets for now. When we look at the growth trajectory into next year, I looked at the profit for the third quarter. It was 8.4%. It was double the estimate, and the trajectory is for profits to rise going into next year, and that is contingent on growth, and that is the one thing that this Trump administration do not want to see suffers. So with that growth trajectory in mind, do you go further out? Danny and myself and Anne-Marie have been talking about this through the morning in terms of smaller and mid-cap stocks. Is that the ground zero for you to get a better return relative to large cap?
I think that's right. So whenever you have rising interest rates, there becomes a tug of war. Like, people say rising interest rates are bad for small cap stocks. That's not really true. Because what happens is when interest rates go up, you get a tug of war between the financial leverage, right, interest rates hurting, and the operating leverage. Why are interest rates going up? Because the economy is stronger than people thought. Nominal economy is stronger than people thought. And smaller companies benefit disproportionately from that increasing operating leverage. So in that tug of war, normally operating leverage wins over financial leverage. It's the same reason why junk bonds outperform when interest rates are going up. Same effect. And so, yeah, I think you want to look at small caps and mid caps. We're quite overweight small caps and mid caps.
Richard, does it make you nervous, though, that everybody's doing that same trade, that everyone's so bulled up on equities, everyone's raising their guidance for the year and jumping in? Is that in itself a reason maybe to be a little hesitant?
Yeah, I think there is any number of different reasons to be cautious. Right now, people are really bulled up. And the stat that I like to quote all the time is the private client equity beta is now up to 1.45. I mean, that is a whopping beta in private client equity portfolios. Monstrous beta. The beginning of the bull market was 0.75. So it's basically almost doubled during the bull market. So people are very bulled up. However, I think if you're talking about equities as an asset class, one has to realize that they're still dominated by the Magnificent Seven. And so, I don't think the risk is equal. I think the risk is disproportionate in those 7 companies. Think of it as a seesaw, if you will. And there's plenty of opportunity on the other side of the seesaw, even though the asset class equities may not do great.
And just looking at some of the measures of positioning, Bank of America say this market is so stretched at an 11-year high. Where do you go for defense? We were talking to Goldman Sachs a little bit earlier on. They're still bullish. They're with the other cadre that Danny has been talking about in terms of the calls for the upside. But where is the defensive play in this? Because the trajectory never remains in a one-way street forever. They were looking at gold. Where do you look for defense in this equity market?
So, Menace, I think that depends on why. If you're worried that the equity market's going to go down, it depends on your view of what's the catalyst that's going to cause the equity market to go down. If you think it's going to be more inflation than people think, a Fed that maybe has to reverse course, getting back to Danny's question before, if you think it's a Fed that has to reverse course, then I think you want more cyclical. They will be more defensive because cyclicals do well in a higher nominal growth environment. If you think it's a fall off in growth, and that we end up heading towards recession, then it would be the traditional defensives, right? You'd want consumer staples and healthcare and utilities and things like that. Right now, we're positioned for the former rather than the latter. We think there's going to be more nominal growth than people think that causes the Fed to kind of hiccup here a little bit.
All right, we will look forward to see what the Fed, we have a ton of Fed speak this week. Richard, starting with Waller today. Richard Bernstein of Richard Bernstein Advisors. Thank you for your time. Let's get you an update on stories elsewhere this morning. Your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Hi, Anne-Marie. President-elect Donald Trump continues to fill out his next administration. Trump tapped former New York Congressman Lee Zeldin for EPA administrator, while CNN is reporting Trump will choose South Dakota Governor Kristi Noem for Secretary of Homeland Security. Meanwhile, we're reporting Trump will pick Florida Senator Marco Rubio for Secretary of State, while Florida Congressman Mike Waltz has been tapped for the role of National Security Advisor. And the European Union has notified Apple that its geo-blocking practices are potentially in breach of consumer protection rules. The EU saying the iPhone maker's App Store, iTunes Store, and other media services unlawfully discriminate against European customers based on their place of residence. Apple has 1 month to respond to the findings and propose solutions. Shares are lower. Employees across Wall Street can expect to receive a higher bonus this year. A report from compensation consultant Johnson Associates finding that year-end bonuses across almost all sectors in the industry are set to climb for the first time since 2021. Investment bankers, traders, and asset and wealth management professionals are all set to see increases in incentive pay reaching into the double digits. That's your Bloomberg Brief. Anne-Marie?
Yahira, thanks you so much. We'll get an update from Yahira in 30 minutes' time. Up next, the morning calls, plus former New York Fed President Bill Dudley on the tension between Fed Chair Jay Powell and President-elect Donald Trump. Wall Street Journal this morning saying they visited this 6 years ago, and there is a legal path to make sure he keeps his job. That's coming up next. You're watching Bloomberg Surveillance.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning. I'm Anne-Marie Herdern alongside Danny Berger and Manus Cranny. Equity markets this morning taking a little bit of a step back. Citigroup is saying S&P 500 positioning suggests profit-taking possible. Well, of course, that makes sense. We've had a 5-day rally, and yesterday we had another record high. We are seeing the Trump trade continue. Bond market back open for business. 10-year yield up 6 basis points, and the 2-year also hitting fresh highs. We haven't seen these numbers since July. Time now for some morning calls. First up, Evercore raising its price target on Disney to $128 from $105. The analyst expecting improving direct-to-consumer profits. Next up, Morgan Stanley raising its price target on Walmart to $89, expecting a modest upside from earnings next week. And finally, Citi downgrading Ross Stores to neutral, citing increased uncertainty tied to its upcoming management transition. Turning now to the Fed. Former New York Fed President Bill Dudley writing in his latest Bloomberg opinion piece, the U.S. Federal Reserve and its chair, Jerome Powell, are rightly choosing not to act on any assumptions about what Donald Trump might do as president. That said, if he follows through on his more extreme campaign promises, they'll struggle to contain the economic consequences, a problem that equity investors ignore at their peril. Bill joins us now. Bill, you've been in the room. You understand what this is like. Give us a sense potentially of this tension that might brew between the Fed chair and President-elect Trump.
Well, in the short run, there's not going to be much tension because I think the Federal Reserve is still going to cut interest rates a bit further. But longer term, if you look at what President-elect Trump is proposing, higher tariffs, deportations, and fiscal stimulus, that's going to tend to boost inflation, disrupt economic growth because tariffs will force people to reorient their supply chains. It's going to make the economic environment more difficult. And so the Federal Reserve ultimately is going to react to that. But as Powell said in his press conference last week, we don't assume, we don't guess, we don't speculate. So they're not going to act until they actually see the Trump agenda actually take form. So don't expect any near-term response from the Fed. But in the longer term, I think if Trump does what he said he's going to do, it's going to be a difficult economic ride.
Well, Bill, as you point out, though, if Trump does anything big or abrupt, in your words, the central bank's response will occur too late to mitigate fully the economic impact. So what is the needle to thread to not respond too soon when we don't know the extent of things, but also not waiting too late that you just can't do anything at that moment?
Well, I do think there's a risk that if Trump is very aggressive in terms of his policy choices, that the Federal Reserve will be late. They'll be waiting to see what happens. And then when it does happen, it'll be bigger than expected, and it'll have bigger consequences for growth and inflation. At that point, I think the Federal Reserve would be a little bit behind the curve, and they might have to actually catch up. But that's not a near-term story. That's probably, late 2025, first half of 2026, just at the time that Powell's wrapping up his term as chair.
Good morning to you, Bill. In your opinion piece this morning, you talk about an oddly divergent reaction from the bond market and the equity market. I want to focus on the bond market because it has been a wild ride. This morning, we waking up, again, the birds have been reawakened. The question I would put to you is this. We don't know the tariff. We don't know the tax. We don't know anything about the fiscal policy exactly. We have some broad parameters. When you look at the term premium in the bond market, the debate is how much more term premium there needs to be if there's going to be such a large deficit run. Some of the numbers thrown out there are pretty obscure. But are we on the brink of where there needs to be a lot more term premium to hold U.S. Treasuries?
Well, I think that there needs to be some more term premium to reflect the uncertainty about the economic outlook and the unsustainable fiscal path of the United States. That's one area where Powell actually did speak out last week. He did say that the fiscal path of the United States is unsustainable. And if President-elect Trump does all of the things he wants to do in terms of corporate tax reduction, extending the 2017 tax cuts, the fiscal situation is going to worsen, not improve going forward. So I think the path to higher bond yields is the most likely path. The other thing that's happened, of course, is people have changed their expectations of where the Fed's going in terms of short-term interest rates. A couple months ago, people were expecting the federal funds rate to bottom below 3%. Now the markets are expecting the federal funds rate to bottom at around 3.75%. So if you have a higher federal funds rate, then you're going to have a higher bond yield just by construction.
So the direction of travel, you say, is higher in yields. When you look at the response from Powell at that news conference, and we've touched on this with various people, are we going to hear much more, I don't know what the right word is, aggressive, demonstrative, exacting language from the Fed? What word would you choose that the Fed's rhetoric needs to become more emboldened in 2025?
I think the Fed is actually going to be very, mild in terms of their language. They're going to set monetary policy based on what they think is appropriate given the growth and inflation outlook. And as you noted, it's going to take time for that to manifest itself because we don't really know exactly what President-elect Trump is going to do. So I think the language will be actually not combative at all. You saw last week, reporters asked Powell about, how he can react to the Trump policy mix, and Powell basically said no comment. So I think in the very short term, the Fed's going to keep its head down and conduct policy based on how the economy is doing right now.
But if we can take a step back to the reaction that we've seen here in the now, as you write in your column, you find the stock market response baffling. Equity bulls have been really excited about the prospects of tax cuts and deregulation. What are they missing?
Well, I think that the stock market has this notion that we're going to have deregulation, we're going to have corporate tax cuts, and that's going to boost corporate profit margins. And I think that's probably a fair part of the argument. But I think what they're missing is all the consequences of the other parts of the Trump agenda. Higher tariffs mean higher inflation. They mean disruption, lower productivity growth. Deportations affect the supply of labor. And unsustainable fiscal path means higher interest rates. When I look at the bond market versus the stock market, I think the bond market, as bond yields rise, that's going to put increasing pressure on the stock market. We're starting from a point that the stock market valuations are already extremely high. So if bond yields go up, I think that will weigh on the stock market. I would not be a big stock market bull at this point.
Bill, given that backdrop, how difficult is this December meeting going to be for the Fed?
I don't think it's going to be that difficult because I think Powell laid it out pretty clearly last week. They think that the economy is, the risks of inflation and the labor market are roughly in balance. They think monetary policy is still restrictive, so that they're heading back towards neutral slowly. So I think a 25 basis point rate cut in December is still the most likely case. Now, if the economy continues to stay stronger than expected and inflation stays stickier than expected, then that December rate cut might be the last rate cut for a while, but that really depends on the data. The Fed right now is really data dependent in terms of where they're going. The direction of rates is downward, but slowly because the economy is continuing to perform pretty well on the growth side.
Last week, Powell was asked a number of times by journalists about what would happen if President-elect Donald Trump tried to remove him. And this morning in the Wall Street Journal, they talked about 2018. And Powell then went with their reporting to Treasury Secretary Steven Mnuchin and said that he would fight his removal of SALT by the president. Are you concerned about the independence of this Fed?
Well, I think you have to always be concerned about the independence of the Fed when you have a president that seems to be, president-elect that seems to be hostile to the Fed's independence. And, the reason why we want an independent central bank is because historically, independent central banks actually do a better job in terms of managing monetary policy to achieve the outcomes that we want in terms of growth and inflation. So independence is really driven by the fact that you actually get better outcomes. If people think that the Federal Reserve is going to change course based on pressure from the president, that increases uncertainty and risk. And it also makes the Fed very short-sighted in terms of its policy agenda. So I think the Fed, basically the Fed's going to try to maintain its independence. Powell, I think, was very, very clear last week when asked about whether he's planning to resign early. No. Whether Trump has the right to fire him legally. No. So Powell basically said pretty clearly, I'm going to finish out my term, which ends in May 2026. And so tried to close off the debate on that whole issue.
Not permitted under the law. He kept saying that, no, no, no. And the Wall Street Journal gives some insight into he knows this because he went through it in 2018. Former New York Fed President Bill Dudley, thank you so much for your time and insight this morning. The Wall Street Journal this morning really goes into how Powell went through these motions already when Trump was tweeting at him and jawboning him and potentially wanted to get rid of him.
If anything, this gives some confidence. The people that I've spoken to, this is about confidence in that, you might have a verbiage between Powell and perhaps the White House that ruckus will come, but steadfast. And this has got consequences for dollar hegemony. This has got consequences for policy all the way around.
Yep, coming up on the program, Sonia Meskin of UBS and Krishna Mamani of Lafayette College as we look ahead to CPI. You're watching Bloomberg Surveillance right here on Bloomberg TV.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning, 8:30 on the East Coast. Let's take a look where we are in terms of equity futures. Yesterday, S&P 500 hit another all-time record high. This morning, as Jonathan would say, and he's out. Good morning, Jonathan. No drama. S&P 500 futures still around 6,000. This is as we wait these personnel changes coming out of Mar-a-Lago. But the Trump trade continues when you look at everyone, especially Ed Yardeni saying, you know what, Manus, we're going to see 6,100 year-end.
Yep, it's certainly it's up there, and it calls a higher level into next year. Some stocks that are actually moving around this morning. Let's just take you through a few of them. We've got Hertz. You need to get out there and rent a few more cars, ladies. Reporting worse than expected losses for the rental car company.
I think we can drive.
I know you can both drive. I know you can both drive. Then keep your eye on this. This is a monster move. We've got Honeywell spiking higher this morning. We have Elliott Investment saying that the activist investor Elliott Investment Management building a $5 billion plus position in Honeywell. This is according to people with knowledge of the matter, and they're going to be pushing for, you got it, a breakup and a number of other things in terms of the payout. So keep your eye on that, and let's just close off with Novavax, my apologies. They see revenue 650 million to 700 million. That originally was 700 to 800, so a real pressure point for them there. And in terms of sales, 175 to 225. Again, that is incrementally below the original guidance, Anne-Marie, 275 to 375.
So some movers ahead of the market cash open at 9:30. This morning, investors eyeing this week's data, including CPI, PPI, and retail sales, plus a ton of Fed speak, with Thursday being the big one. We're going to hear from Jay Powell, the Fed chair himself. Joining us now, Sonia Meskin of UBS. Sonia, thanks so much for joining us around the table. So a slew of data this week. What are you looking at?
We are looking at CPI. We do think, obviously, that's important. And something
Inflation still matters?
Inflation still matters. Politics, obviously, front and center. But with the CPI specifically, we expect some actually stickiness in the goods sector from the used vehicle prices, and that should persist into the year end and probably into the first quarter of next year. And then there are some seasonal factors that are going to keep inflation a bit sticky. So that is something to keep in mind as the Fed kind of navigates this rather new environment.
Well, over the weekend, we heard from Neil Kashkari that said, we want to make sure inflation is vanquished. It's a bit of a different Kashkari, who before had said the labor market is our first and top concern. Do you expect to hear that change in tone more widely from the Fed? We're going to hear from Waller, among others, today. Do you expect them to maybe not sound as dovish as they did in that decision to cut 50 basis points?
You know, the Fed has been saying for quite some time that they're data dependent. And the challenge with that is that you have to react even to some temporary influences in the data, right? You can't just ignore them when you come out and say, oh, we're very data dependent right now. So even though we, for example, and we believe the Fed as well, continue to expect the inflation to slow into 2025 and throughout 2025, barring tariffs, et cetera, and expectations from consumers potentially from that and businesses of higher prices, we still think that they need to somehow acknowledge if inflation is temporarily sticky.
And this is part of your argument that you get another 25 basis points in December time, in the December meeting, and then we continue with a slightly intransigent inflation. Where does that intransigence and stickiness come from? I think one of your colleagues said to Danny and I, Paul Donovan, of course, nobody pays owner equivalent rent, but we do pay, well, some of us do pay rent. So where does this stickiness come from?
You know, a lot of it, and this is very challenging for the Fed, a lot of it is the seasonal factors. So there's different adjustments that happen pre-COVID and then post-COVID, and some of it is not necessarily felt on the ground as much as it's in the data. And conversely, in the data, sometimes you see things that, or don't see things that are felt on the ground. And it's challenging for them to actually communicate that to an average person, which is another reason why they have to acknowledge even temporary stickiness.
So
talking about the current inflationary environment and things coming down while you have this great fear that's been building in the market of the inflation to come. I mean, you pointed it out. Sure, they can keep cutting if we don't get X, Y, and Z. I mean, those are pretty big ifs at this moment.
Absolutely. But even from the perspective of a Fed observer, they're very difficult to model. We don't know how things are going to shake out. We don't know tariffs, for example. Take tariffs. We don't know if they will be imposed. We don't know in what form. We don't know if there's going to be a retaliation. We don't know the impact on business and consumer sentiment. How do you model all of that out? You can model different scenarios, but you can't set policy based on any one of those scenarios right now.
Well, the expectation certainly is that bond yields will be going higher, at least on the long end. Because of that fear, sure, the Fed can kind of bring short end rates down as they're cutting. What does it mean to have an environment for them where they're cutting and the cost of capital is getting higher, where it's getting more expensive to take out loans, it's getting more expensive for mortgages because of the fear of growing fiscal narratives, of growing fiscal deficits?
Absolutely. And this brings us to the question of financial conditions. How do you measure financial conditions, especially when different parts of the economy are facing effectively a different set of financial conditions, right? We know that small businesses are much more impacted by higher rates than larger corporations, for example. Lower income, lower savings parts of the consumer population are also more impacted by higher rates than higher net worth individuals. So the Fed has somewhat of a blunt tool for a bifurcated economy.
The political economy is starting to become a lot more important, it almost feels like, than the central bank. And it's going to be leading the central bank to where they go to next. You're one of the first notes I've seen in a while that is actually talking about the trajectory, the scenario analysis of what we need to pay attention to the start of next year. And you're looking at the debt ceiling, because that's going to kick off in January.
Absolutely, because we believe that this will potentially affect sentiment. If small business owners are not only facing higher rates, because the term premium is effectively higher, due in part at least to some of this uncertainty, then the debt ceiling negotiations can potentially introduce even more uncertainty.
Well, it's going to be uncertainty, that's for sure. And potentially we still need the makeup of Congress and how they're going to even deal with a problem like that. Day one agenda item is the debt ceiling. Sonia Meskin of UBS, thank you. Let's take a look where equity markets are. I think, Danny, that point about the fact that the Fed is almost on a different universe. They're looking at an economy that almost might not exist come January because the market right now continuously pricing in Donald Trump's policies, whether that's deregulation, whether that's tax cuts, and whether, of course, that's going to be tariffs. You see right now markets relatively flat after another record high yesterday.
I thought you were going to say that equity markets are also living in another universe alongside the Fed. I mean, we kind of heard it from Bill Dudley there, right? Perhaps one of the first non-bulls we've heard from in some time, that equity markets, and Anne-Marie, I think you said this earlier this week, they're pricing in all the good stuff and none of the bad stuff. We are off to the races, and I got to say, the sell side note after note saying that we can move higher and we are upping our price target.
Maybe pricing in the bad stuff, though, Manis, is the bond market. Yields are higher, 2 years higher since July. There is this concern that there's going to be a tremendous amount of fiscal spend in Washington, D.C. The 10-year yield now up more than 8 basis points.
And look where that movement is on the short end of the curve. That is about recalibrating what you think that the Fed can deliver in 2025. Everybody's talking about a higher terminal rate. You've heard it from a number of people. Kathy Jones said it this morning. I love what Bill Dudley had about to say. He would not be a stock market bull at the moment. And the divergent reaction between the bond market and the equity market, not really understanding the equity market's response mechanism. But of course, it's going to come down to, you know, how much term premium do you get to hold U.S. Treasuries? And that is going to be one of the biggest challenges for the bond market participants.
Markets are in the throes of Trump trades. Not my words, the words of our next guest, Krishna Memani, of Lafayette College. Okay, I love this line that you said. They're in the throes of the Trump trade. We see that continuing. Is it sustainable or not?
Well, I think that's an open question. The sustainability of the euphoria in the equity market depends really on the policy set that gets unveiled. And we have ideas, but we don't really know. But at the same time, I think
concepts of a plan,
and things that were articulated during the campaign. If all of them come about, then I think the inflationary concerns are real and something that we should pay a great deal of attention to. But it's unclear at this point whether all of them come together as a package. And the Fed is right now saying that they are data dependent. I think in 2025, the Fed is going to be saying that they're data dependent and policy dependent. You know, that's how they will articulate it, because as Powell said, you know, they can't really model whatever is going to come down in a premature fashion. They actually have to see what the details are and then build it in the model. So I think the policy uncertainty is there, and policy uncertainty will continue. At the same time, the euphoria will continue for a while as well.
Well, Krishna, just to pick up on that, because you've got Mohamed El-Erian saying that these are perfectly rational market responses that we have seen so far. Exuberance in equities, one can call irrationality in Bitcoin, whatever, but the momentum is there. What is it that tempers or curbs that? Because the bond market has not done so yet in terms of that rise in the equity market. So what could be the spoiler alert if we're not going to get a 2016 redux between now and the end of this year?
Well, so I think 2016, you have to put the 2016 in the context of 2015, much the same way that you have to put 2025 in the context of 2024. That is, we have had a rip-roaring rally in the marketplace. If it didn't have that, you know, the likelihood of that continue on the back of deregulation, profitability, growth, tax cuts, I think would be real. But we have had a substantial market rally. So, you know, at a fundamental level, things look good. But at a valuation level, when Costco trades at 57 times earnings, you have to kind of ask yourself, how rational is that for a retailer?
Yeah, I mean, well, everybody tells us that the consumer is doing grand, the consumer is doing fine. Tell me this then, the valuation on equities is primarily based on a growth trajectory for 2025. That's what a lot of people have said to us. It's not about rates, it is about growth, and that is what will sustain the upside. So if you come to a situation where you have a dramatically less cuts from the Federal Reserve, what does that do to the growth narrative, and then does that challenge the highlands that we're talking about in these equity markets?
Well, so I would say that the growth drivers are basically native to the economy rather than policy. I think the strategy the strategy that the Fed is implementing is not getting in the way of that growth dynamic. So if you kind of frame it that way, then the underlying fundamental improvement can continue for a little while longer. The real question is that already discounted in things like profitability growth, profit projections, things like that. You know, Yardeni comes up with roaring 20s. I think conceptually that makes some bit of sense. But is that going to be linear, or we basically need to stay here for a while before we go there? I think is the question we ought to be asking.
So if the Fed is forced to stop around 4% because of inflationary policies, can corporate profits and households handle that? Are we in an environment where, given over the past few years, that's going to be okay and growth can continue in that scenario?
So I think if you look at the history, you know, what matters is really long rates far more than short rates. They're correlated, but that's not the driver for the economy. Longer rate, and you know, 4.30 in 10 years is higher than what we are used to at 2%. But in the context of a really good growth environment, is 4.30 so irrational or so detrimental to the growth dynamic? Yeah. And I think that's that's up for debate. I don't think it is going to matter that much, and it's not as restrictive as people think it would.
Okay, but Krishna, we have this real risk that duration is underpaid, that long-term yields go higher because of concerns about the fiscal deficit, and that is something that's kind of out of the Fed's control. So what happens if financial conditions are tightening and the Fed wants to be cutting, and you have just a long end that they can't control? I mean, kind of echoes of what happened in the UK, maybe not as extreme.
Well, so I think UK is a totally different situation.
Sure.
Economically, they are in a different place. And I think there is a risk that you have a situation where, because of the fiscal impetus, the long rates continue to go up, and the Fed, maybe stalls out at 4%. But I think that combination in and of itself is probably not terrible for the equity market, because on the back of it, you'll probably get growth, and it'll be nominal growth, but it'll be growth, and stocks are nominal instruments, and they'll probably react accordingly.
Look, we talk about the wealth effect and a bifurcated consumer, but if we look at those people who have a mortgage, some people around this desk do, some people around this desk don't. So 50% of US households have fixed their mortgages somewhere around sub 4%. The lucky people, somewhere around 2.5%. That will live long and large in supplanting the COVID money that was there. And that is the other tale that we need to begin to understand. We underestimated the COVID money, and I think we are underestimating the tail of the mortgage boost.
So I think the tail of the mortgage boost and kind of the impact of that on consumer health, you have seen that in all of 2024. That is, despite the fact that mortgage rates, that new mortgage rates went up, things didn't slow down. What did slow down was the cyclical part of the economy. I think if you look at the housing market, that has been in the dumps for a while, and I think if mortgage rates remain here, that is probably going to remain in the dumps for a little while longer. But consumption, on the back of what you are arguing for, it has been pretty decent. So yeah. I think that is getting factored in. It's a reality that we have to deal with, but I think the markets have kind of dealt with that for a while.
I just want to end with this, Krishna, of you saying it's hard to stand in front of the freight train of this bullishness, and I think a lot of people feel that way right now. What understanding do you have of just how far we've gone? I know you don't want to step in front of it at this moment, but what looks mispriced to you in the aftermath of the election?
Well, so I think you had asked the question that, how would it end? How would this bullishness end? And I think the way these types of bullish moves end is because they exhaust themselves. That is, it is not because of some catalyst in the market or economy. I mean, that could certainly provide be a driver. But at the end of it, after a while, after everyone has bet on the move, basically there's nobody left. And I think that's the situation we'll be facing in not too distant a future. And then it'll be driven by whatever policies get implemented.
But Krishna, right now, why is the market pricing in all the good stuff potentially we can see from this trifecta in Washington, D.C., and not some of the negative market implications, like a very strict immigration policy, especially look at some of the personnel that the former president is going to be leaning into, as well as higher tariffs?
Animal spirits. There is no kind of, animal spirits are rational, so I can't say they are irrational reactions, but the point is, it is not being driven, or in my judgment anyway, it's not being driven as much by fundamentals. I think the 2024 to late 2023 rally was driven by fundamental improvement. Now it is really animal spirits, and again, they exhaust themselves in due time.
Krishna Memani, thank you so much for your time this morning. Krishna Memani of Lafayette College. Let's get you an update on some of the other stories we're watching this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. The Biden administration is unveiling plans for the U.S. to triple nuclear power capacity by 2050. This includes constructing new reactors, reopening plants, and making upgrades to existing facilities. These goals could be supported under President-elect Donald Trump's administration. Trump has voiced support for new nuclear reactors to supply power to data centers amid an AI boom. Meanwhile, Tyson food shares are surging in the pre-market, up 5.8% after delivering better than expected fourth quarter earnings. The company said it expects results to improve next year as a turnaround in the chicken business and rising demand for prepared foods offsets losses in its beef category. Still, profits remain constrained by a cattle shortage in the U.S. that is not expected to improve before at least 2026. And online grocery prices declined in October from a year earlier. That's the first such drop since the pandemic. You have to go all the way back to January 2020 to see an annual decline. Data from Adobe that's based on about 1 trillion visits to retail sites and more than 100 million products purchased showed that among the 18 categories tracked, 2/3 of them are now in deflationary territory. Something to watch tomorrow when we get CPI. That's your Bloomberg Brief. Anne-Marie?
Absolutely. Thanks so much, Yahira. Up next, setting you up for the day ahead. Yahira said it there. CPI on deck. You're watching Bloomberg Surveillance.
Many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to Bloomberg Surveillance. Very good morning to you. We're going to count you down to the opening bell. The trading diary for the week ahead is as follows. This week's Fed speak from Governor Waller. Tomorrow, we'll get CPI plus remarks from Musalem. Thursday, PPI, another round of jobless claims, and more Fed speak from Powell, Kugler, Barkin, and Williams. Plus, Disney reports after the closing bell. And Friday, we'll see the hedonism, as Paul Donovan calls it over at UBS, of the American consumer with retail sales. All of this as Donald Trump solidifies cabinet picks. He's set to meet with President Biden at the White House tomorrow. Joining us now, Bloomberg's Mike Shepard. Bloomberg, Shep, what can you tell us about some of these personnel picks? Because as we all know, personnel dictates policy.
Well, you're right, Anne-Marie, and Donald Trump is acutely aware of this. Based on his first term in office, you'll remember the chaotic first 2 years when we saw all of this turnover. anchor when it comes to thinking about and discussing economic policy. And yesterday he published an article in the Wall Street Journal, an op-ed that pointed to how markets were embracing the new version of economics under Trump 2.0 that the administration would like to deploy as policy. And that, of course, is something that would endear himself to the president-elect. He even had a line in that saying, "The dollar loves you." And that is exactly the kind of thing that will win Trump over. But also with the Senate, Trump would get somebody who knows how to speak to the markets. And this is critical because he will want to have someone out there to reassure investors about the stability and direction of the U.S. economy. And he will also need somebody who can speak with authority as he is trying to get his tax cuts and other proposals through Congress.
Mike Shepard, thank you so much for joining us. So when it comes to Scott Bessent, guys, he's actually leading in Polymarket, 83%. It feels like a market endorsement of this individual. And we know that Donald Trump cares about the betting markets because they accurately predicted his win.
Yeah, I mean, what was it? When we sat around the desk yesterday, it was 80%. This morning's gone up by another 3%. But I think to Shep's point, it's about who can speak to Donald Trump in such a way that if you're going to couch these fiscal plans and the other plans and your tariff war plans, and what impact that will have on equity and bond markets.
Danny, you were accurate, though. This is what the street wants to know. Who is going to be the Treasury pick? Coming up tomorrow, Drew Pettit of Citi, Seema Shah of Principal Asset, also Kevin Gordon joining us, and David Kelly of JP Morgan Asset Management. Thank you for joining Danny Manis and myself. John and Lisa are off. Lisa will have some interviews for us later in the week. Enjoy your morning. This is Bloomberg Surveillance.
Welcome to a special Nido ATP Finals update for Bloomberg TV and radio from Tennis Channel. Casper Ruud upset Carlos Alcaraz in the biggest shock of the tournament so far Monday. The Norwegian capitalized on a lackluster display from the Spaniard, fighting back from 5-2 down in the second set to close out his 50th win of the year. Ruud reached the final in his previous appearance at the season finale 2 years ago. And don't forget, Tennis Channel's daily live coverage from Turin starts at 5:30 a.m. Eastern.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people are.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these...
I think everyone, of the 8 billion people of Earth, I think everyone's going to want their Optimus buddy. And there's going to be maybe 2. And then they'll be producing products and services. I predict, actually, provided we address risks of digital superintelligence, 80% probability of a good outcome. Look on the bright side. The cup is 80% full. The cost of products and services will decline dramatically, and basically anyone will be able to have any products and services they want. It will be an age of abundance, the likes of which people have almost no one has envisioned. It'll be something special. So, now one of the things we wanted to show tonight was that Optimus is not a canned video. It's not walled off. The Optimus robots will walk among you. Please be nice to the Optimus robots. So you'll be able to walk right up to them, and they'll serve drinks at the bar. And you'll directly, I mean, that's just, it's a wild experience just to have humanoid robots, and they're there, you're just in front of you. So, yeah, with that, let's party.
This tight, right now just 0.74% away from treasuries, and with spreads this tight and valuations this high, it makes you wonder if something could go wrong.
Have to bank on higher yields alone, Matthew. Let's take a look at some stocks moving here under the surface. We're looking at e-commerce giant Shopify surging. Revenue topped analyst estimates. The free cash flow margin also expanded. Shopify now up more than 22%. You also have Home Depot showing some green when it comes to the consumer, up about 1.7% pre-market. The forecast is higher on renewed demand for do-it-yourself materials. This is the big story of the day. Activist investor Elliott has built a $5 billion stake in Honeywell, according to sources telling Bloomberg. It is the largest investment by Elliott in a single stock. The activist investor is pushing for a breakup. Honeywell is up almost 7% pre-market, Matt.
Yeah, but Honeywell is up only 7% this year to date. Honeywell's up only 25% over the last 5 years, while the S&P 500 has tripled, right? The industrials index is up, I think, 75% or something like that. So Honeywell, something needs to change at this conglomerate. And there aren't many giant industrials conglomerates left.
That's the thing. It really feels like the era of the conglomerate is over. We've known that for a while, but this story, a real sign of the time. And when it comes to these activist investors, spinoffs are really popular, and they've been very well received by the market. Bloomberg actually has a spinoff index, some of these recent spinoffs. It's at an all-time high, as you can see right now, up over 165% over the past 5 years. So it makes sense why Elliott in particular is reportedly taking this route.
What's interesting about it, too, is you recently have had Honeywell do large deals, so potentially an unraveling even after you saw them buy Carrier Security Unit, Air Products Unit here as well when it comes to liquefied natural gas. They have been a buyer of things spun off of other businesses.
That said, it did announce last month that it's spinning off its aerospace, it's spinning off its advanced materials division. So it has tried to streamline a little bit.
It sounds like a 60s company, right? They have advanced materials, they have aerospace, they have industrial automation.
Yeah, it's something that would the men in Mad Men would advertise for.
I will quickly say, too, this all gets more heated when you think about how much M&A is expected next year with the lack of regulatory oversight expected under the Trump administration.
Hey, did you read the Chris Hughes column? Because
the guy who thinks
the contrarian
don't be so
column.
sure.
The contrarian column.
Let's bring in BNY Wealth CIO Sinead Colton Grant. She joins us on a day when maybe we're going to pause the incredible rally that we've seen, but it has been insane. I mean, S&P 6,000 is here already, and a lot of strategists don't have that penciled in for year-end 2025. So what's your take on the broader market?
Well, first of all, it's not about today, it's not about yesterday, it's about where we go over the next 12 months. We know stocks react to earnings and interest rates. It's always about the fundamentals. And one of the reasons why we've seen such a strong reaction in the equity market has been because the expectation is less regulation. We'll see earnings improvement, we'll see a bigger boost to the economy, and that's all extremely positive. And by the way, we didn't have 6,000 penciled in, but we were close to the top of the range at 5,800, and we are looking for 6,300 next year.
What role does interest rates play here? We were talking a little earlier, Katie mentioned you have the 10-year getting back towards that 440 level. At what point does that start to hurt what you're seeing in the exuberance in the stock market?
And that's the interest rate component, right? So I think what's been very interesting since we had the election results last week was just how the bond market has reacted. And it feels a little bit more like the equity market reaction following the 2016 result. There's an initial knee-jerk concern this time about the debt, the deficit, and what that's going to do to interest rates. It's probably a little short-sighted in my view, because it is highly unlikely that we're going to see the Trump administration adopt policies that become very inflationary, because if you look at what all of the results are telling us, it was the hurt that consumers were feeling from cumulative interest rate or cumulative inflation rises and interest rate increases that really swayed their view on the economy and led to the Trump victory. So I think the bond market is overreacting at this point. Now, yes, debt levels are high. The level of government debt at about 100% is very high. We do need to be cognizant of a high deficit at a time that we're not in recession. But it's too early to really make a conclusion from that in the bond market.
So the bond market overreacting. Let's talk about whether or not stock investors are overreacting. There were some great sell-side notes out this morning. You had Bank of America in their fund manager survey finding that U.S. equity exposure is at an 11-year high. You had Citi building on that, saying that positioning is at a 3-year high. And they went further and said that actually you're going to see people take some profit here, and we could see a cool down right now. When you take a look at your various positioning metrics, where does that leave you on some of these technical forces?
We've been overweight U.S. large cap for the last 18 months, and that's performed very well for our clients. But look, some consolidation at these levels would be healthy, but the underlying fundamentals are strong. So we're expecting earnings growth of just under 9% for 2024, just under 15% for 2025. Those are very robust numbers, and they'll really underpin the market going forward. Now, when we look at tech relative to the valuation of the rest of the market, we don't think it looks overvalued. In fact, it's a sector that we quite like.
I was reading one of the notes, Katie is talking about the Bank of America note, and I was struck by the prediction of no landing. I think we have the note that Michael Hartnett and his team say post-election results show higher global and U.S. growth expectations, higher inflation expectations, lower probability of a soft landing. And I translate that into no landing, right? Because we're still inflated, we're still elevated. What do you think about the inflation risk?
Well, first of all, I think it's hard to talk about no landing, because it will be a soft landing, even if it's the softest of soft landings. When we think about growth for 25, we're expecting that growth in the first half is a little bit slower, and then it reaccelerates in the second half in order to, as you really see the impact of those rate cuts from the Fed coming through. Look, inflation, we've got a print tomorrow. We're already seeing headline at 2.4%. Expectations are that it moves up a little bit, but here's the thing. The Fed tells us constantly that they are going to be data dependent. So that's interest rates, that's the unemployment rate. And what we're really looking for tomorrow in that inflation print is the shelter number. We want to see that continue to move lower because it's the stickiest component. It accounts for about 40% of the index. And we're expecting to see continued progress on inflation. Now, may it settle at a slightly higher level than we saw post the financial crisis, maybe in the 2.5 to 3% range longer term? That's entirely possible, but those are not problematic levels of inflation, and equity markets have done incredibly well at those levels.
Right. Well, Sinead, what do you see as the driver from here? Do you think it's going to be the economy? Do you think that there's more room to run in this political trade? Do you think it's going to be earnings, which have been a little bit lackluster? Or could it be positioning, the fact that seems to be out there that this is a stock market that maybe is over-allocated?
Well, let's take a step back for the moment.
If you don't allocate to US stocks, where do you go? Do you look outside the US? And then you need to think about cumulative GDP growth since 2020. Here in the US, it's been over 11%. You go to the Eurozone, that's the next best, by the way, it's under 5%. You go to Japan, the UK, it's 3% or lower. And so I think in answering that question, it's really important to take account of the broader economic drivers. So the US economy is, we expect, going to continue its leadership of the global economy. When you look at the innovation that is inherent within the S&P 500, the components of tech, communication services, and now when we think about AI and productivity gains, that is really positive for US stocks and particularly for large caps.
All right, Sinead, that's a good place to leave it. Really appreciate you taking the time this morning. That is Sinead Colton-Grant of BNY Wealth. It's a very quiet morning on the index level. Let's see if we can find some action under the hood. We'll do that with Abigail Doolittle.
Well, beneath the surface, Katie, we have the shares of Hertz plunging down 6.5%, or down sharply, I should say. This after they missed estimates in a significant way. The revenue estimate they missed, plus down about 5% year over year. They put up a much bigger loss of 68 cents versus the estimate for a 48-cent loss. They, in addition, took a $1 billion impairment charge. Now, into today, the stock down nearly 70%, adding some heft to that. And there is a stunning 39% bearish short interest on this stock. So a lot of investors out there interested in Hertz, not so surprised by these results. Speaking of short interest, but going in the other direction, Live Nation, some of this gain on the day, up 6.4%, could have to do with a short squeeze. There's an 8% bearish short interest there. They put up a third quarter adjusted operating income that was better than estimated. In fact, Jeffrey is saying that it carried the day. And then finally, that Trump trade, the crypto piece of it. Today, a little bit of softness to that. We do have Bitcoin and some of the other coins coming off of record highs. And as a result, many of the names associated with that crypto trade, well, they're down today in the pre-market, down 3.8%, but it's been a pretty stunning rally into today. Some profits being taken off the table. Shanali.
Yeah, seriously stunning 7-day rise, a little of a breather now. Abigail Doolittle, we thank you for your time. Now coming up, bonuses set to grow on Wall Street for the first time in 3 years. More on that next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
In case you missed it, on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of a technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like demystifying a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. politics to the world of business, Joe Matthew and Kaylee Lyons deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg.
Let's get now to high interest, a look at what's making headlines around the world. Analysts say China is likely to embrace more stimulus, boost its manufacturing, and allow its currency to weaken as a way to offset the negative effects of a second Trump presidency. The president-elect has threatened 60% tariffs on Chinese goods that could decimate U.S.-China trade and hurt exports that have been a rare bright spot for China this year. Meanwhile, Donald Trump is expected to elevate a pair of China hawks in a sign that U.S.-China relations may deteriorate further in the years ahead. Florida Senator Marco Rubio and Representative Mike Waltz are set to be named Secretary of State and National Security Advisor, respectively. Rubio has been sanctioned by Beijing, while Waltz has declared that the U.S. is in a Cold War with China. And Wall Street bonuses are expected to climb across almost all sectors of the industry for the first time in 3 years. That's according to a new report from compensation consultant Johnson Associates. Investment bankers, traders, and asset and wealth management professionals are all set for double-digit increases in year-end incentive pay. Bankers who help companies sell debt might realize the biggest gains, with payouts set to rise as much as 35%. Janelle?
Seriously large boom here you have seen in debt underwriting, and of course those bankers ready to get paid out, Matt. But we're going to switch gears. We're going to talk about Main Street a little more, because Home Depot lifted the forecast for the year as demand for do-it-yourself materials was driven higher, but it was driven higher by bad weather. Bloomberg intelligence analyst Drew Reading has the details, and one thing that really struck me was the expectation moving forward, this kind of reliance, if you will, Drew, on this idea that mortgage rates need to get back down to at least 6% to see a bigger tail end here. How do you think investors read that, given how much volatility that there has been in interest rates?
Yeah, housing is certainly a big component of the Home Depot story, and the volatility in rates, I think, has held a lot of people back. We saw rates come down to the 6% range in September. We saw a corresponding improvement in housing demand, but in just a matter of weeks, we were up 90 basis points, even after the Fed cut, and now we're hovering around 7%. So that continues to put home ownership out of reach for many. So you have the housing component on one hand, but on the other hand, I still think Home Depot is partly just a broader macro story. You have consumers who have been under pressure by the cumulative impact of inflation, and still that just general broader sense of economic uncertainty. So we've seen consumers pause. We've seen a slowdown in big ticket discretionary spending. So we think that's kind of on a relative basis where Home Depot is seeing the weakness.
And with that being said, that this is a macro story, broad brushstrokes, what does that portend for Lowe's, Walmart, Target, who we're also waiting for in the coming weeks?
Yeah, so I think the home improvement retailers are in a little bit of a different position. Their consumers tend to be a little bit higher end, as you would expect. The majority are homeowners. They tend to have higher incomes. And I think while the business has certainly slowed, overall spending has held up pretty well. And I think a lot of that has to do with the wealth effect, not only from rising home prices, which have built homeowners' equity, but also the equity portfolios. The stock market gains have kind of kept spending going in this segment of the market compared to some others. And we've heard from a handful of the suppliers that there has been a trade down. So you're seeing some of the higher end products outperform the lower end.
What's your outlook, Drew, for the housing market in a broader sense, especially as we get a new president coming in? We don't expect to see, obviously, the Harris plan to build, what does she want to build, 300,000?
3 million.
3 million new homes. But we did hear that Trump wants to goose the market some. I mean, what are people in the industry talking about?
Yeah, so a lot of the proposals we heard from the administration gear more towards that new residential construction side. We think that the existing home market's going to have a tough time getting back to normalized levels with interest rates 6.5% to 7%. The other thing you have to consider is when you look at broader affordability, it's not just rates. Sure, they get all of the attention, but home prices are up more than 50% since pre-pandemic levels. We did an analysis recently that showed that property values would have to fall about 30% for monthly payments relative to incomes to get in line with historical averages. Now, we're not saying that that's going to happen at the national level, but there's different pockets across the country. So, you know, the housing affordability equation is complex, and it's not just about rates. That being said, when you talk about the home improvement retailers like a Home Depot and a Lowe's, what you have to remember is that while from an absolute volume perspective, things may not be back off to the races, we've been hovering at these depressed levels for, you know, the better part of 2 years now. So the comparisons for them do start to get easier. We do think you could see some growth, albeit off a very low base.
Andrew, something that we're asking about all retail names is what's the potential impact of tariffs, of course, as Donald Trump returns to the White House? My understanding is that Home Depot sources most of its goods domestically, but how are you thinking about tariffs when you're analyzing some of these names?
Yeah, great question. And there's still a lot we don't know, but Home Depot is one of the largest importers just based on their scale. But like you mentioned, their exposure to China is probably less than what you'd think, probably just inching up into the double-digit range. As you said, they do source a majority of their products that they sell through North America channels. So when you compare them to some of the other retailers, maybe like apparel, footwear, or home furnishings, the impact is certainly going to be less.
Or Amazon.
Exactly. You could see some pressure on the gross margin side. But like I mentioned, I think it's muted compared to what we're going to see from some other retailers.
True. One reason we're watching Home Depot today is, of course, that health of the consumer, the housing market, but it is really the first of the big box retailers to be reporting. What do you expect out of Lowe's and Walmart?
Yeah, so I expect really more of the same out of Lowe's. And that's really that the market for big ticket discretionary items is likely to remain weak. And you know, this plays across the retail space where you just have, in general, a more cautious consumer who's putting off that kind of purchase. They tend to be tackling smaller scale projects or doing things in piecemeal rather than, you know, taking on those big ticket projects that need to be debt financed. And that's really one of the areas that Home Depot and Lowe's have called out over the last several quarters, things like kitchen and bath, where interest rates are really having an impact on consumers' ability to finance those projects.
All right, Drew, great to get some time with you. Really appreciate it. That is Drew Redding of Bloomberg Intelligence. Meanwhile, we are less than 10 minutes away from those opening bells. More market coverage ahead. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
There is
this real momentum from Wall Street? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
All right, let's take a look at futures right now. We have 6 minutes to go until the bells ring, and maybe that'll introduce some action into this market because at least on the index level, it's pretty quiet. You have the S&P 500 in the futures market down a little bit. Big tech as well. Even the Russell 2000, of course, those small caps have been your leader, but not anymore, at least for today. The Russell 2000 currently off by about 0.6%. It's possible that people are taking profit here. That's what Citi said is going to happen here because you have a lot of people coming back into this market. Bank of America out with that note, of course, that positioning is at an 11-year high. And guys, I wonder, it gets back to some of those things we were talking about with the household surveys, basically that everyone's already in this market. Who's the marginal buyer? And maybe it is time to just lock in some gains.
Yeah, I think Cole Smead has come on and talked about the St. Louis Fed that looks into how much households are invested in stocks, and they found that right now it's the most ever since they began keeping data in the 1950s. So we're definitely fully positioned here, no matter what index or proprietary algorithm you look at.
Right.
Citi, it's
we're
just
holding,
we're heavy on stocks. Yeah.
Leverage is also near all-time highs for big institutional investors, and you look at where we are in the rest of the year. You have a few more earnings left, a few more weeks of earnings, I suppose, but really the last catalyst was the election. We have that drip drab of political appointments coming out. Maybe less regulatory bent in the government would help unlock some of these sectors. I'm looking at banks today because you really only still have the yield curve at a disinversion of about 5 basis points. Even
That's
with
why you're looking at banks today?
Well, oh yeah,
You're looking at banks every day, Shonali.
Well, today in particular, we're interviewing Jane Fraser at 2 o'clock. So
yes.
that is going to be a big
interesting
insight into how the banking sector will perform.
All right, catch that interview at 2 p.m. And coming up on this program with less than 4 minutes to go, we'll talk with UBS Global Wealth. This is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
We are moments away from the start of trading after yet another record high on stocks yesterday. Currently, doesn't look like we're going to be repeating that, but I mean, who knows? We're basically unchanged right now in terms of S&P futures, NASDAQ futures as well. Russell 2000 down a little bit, but as Shanali has been pointing out, we're getting, I think, a little bit heavier than a drip feed in terms of information on who is going to fill Donald Trump's cabinet, and that may spur investors to jump in even more, to the extent that they still have any cash. I think appropriate to the Trump win, you have the UFC ringing the bell at the New York Stock Exchange. That tracks. Cirrus Logic at the NASDAQ, I believe it's been 35 years since they've been listed on that tech-heavy index. Let's get a check at the major averages right now, even though, KD, I think right now doesn't determine what we're going to see at the closing bell. It's just a blank canvas. It's just a platform from which we take off, right?
You are so right, Matt Miller. Anything can happen between now and 4 p.m. today, but at least for right now, it's crickets. You have the S&P 500 a little bit higher. That's all you need for all-time highs, but pretty tepid gains right now on your big benchmark. Big tech kind of deciding what to do. The NASDAQ 100 currently flat on the day. It's been bouncing back and forth. But then you have the small caps, and they are firmly lower right now. On the Russell 2000, down about 0.6%. This has been your winner, so maybe investors taking profits here. But let's dial down into some specific earnings, because we've been talking about Home Depot all morning. Of course, it raised its forecast as extreme weather boosts demand for DIY materials. You can see shares higher by about 1.2%, and this is a stock that's been faring okay. It's up 20% year to date, lagging slightly, but still faring better than some.
Katie, I'm keeping an eye over here on that Honeywell story, also up on the day, up about 6%. Activist investor Elliott has built its largest ever stake in a single company at $5 billion in Honeywell, according to sources who told Bloomberg. Honeywell is climbing now by the most in 4 years, Matt.
Yeah, that makes sense. It hasn't had really a great 4 years. Let's talk about the Canadian e-commerce giant Shopify, because apparently so many people on the staff get stuff from there. It reported third quarter revenue that came in ahead of estimates. Shares are surging the most since August. Did we confirm, do they trade here in the U.S., Shopify, or is that like the Toronto
It's definitely a
Stock
Canadian
Exchange?
company.
Okay, so yeah, no, apparently the shares trade here as well, and they're up 21%. I mean, that is massive. That is a huge jump for a Canadian company. Let's take a look, though, back here in America. Refocus on the Trump trade. For that, we bring in Bloomberg's Abigail Doolittle. Abby, what do you see today?
Well, after the best 5 days for the S&P 500 in a year, right now we have that S&P 500 flipping between very small gains and losses. If higher again, it will be yet another record high, and it was higher a moment ago, so I believe that would be an all-time high, although don't quote me on that for sure. In any case, if the S&P 500 were to flip higher, that would be a 6-up day in a row, so that long streak. But you can see pieces of the Trump trade taking a breather today. DJT, Trump Media and Entertainment, and then, of course, Tesla, which was up some 30 to 40% over the last 5 days into today. Elon Musk, of course, a big piece of the Trump campaign and potentially some piece of the administration, although we, of course, have not heard that yet. As for the piece of the Trump trade that's been capturing everyone's attention recently, that is the crypto trade. But today, a little bit of a breather after Bitcoin was above $87,000 per Bitcoin. We now have it cooling off just a little bit. This is true, too, for Ether. And then some of these stocks, Mara Holdings yesterday, I believe, was up 29% today, giving some of that back. Riot Platform giving much of it back, down 9.2%. But again, in the context of big double-digit gains in just 5 days. When we put it into the context of the chart, this is interesting because these technicals have been calling for Bitcoin to come back down to its long-term uptrend consolidation as has happened in the past. But instead of doing that here, it looks like we might be doing something more similar to out of the 2020 election, where we're going to stay elevated for longer. And you can see today's decline. Well, Katie, it's not even registering in the RSI. It is still overbought and going higher, suggesting that the Bitcoin buyers, well, they're just taking a breather today. They may be back pretty soon.
All right, Abigail Doolittle, thank you so much. All those Trump trades taking a bit of a breather, but as you say, just a blip on the longer-term charts right now. Let's keep the conversation going with UBS Global Wealth Head of U.S. Equities, David Lefkowitz, joining us now. And I want to talk about positioning. You have Citi saying that positioning is at a 3-year high. Bank of America says actually it's at an 11-year high. This is a fully allocated market. And yet you have more than $6 trillion in money market funds. David, what do you make of the state of play on positioning, and how does it factor into the road ahead?
Yeah, thanks for having me, Katie. So yeah, I think there's been no doubt that we've seen an increase in positioning, not surprising given the pretty strong moves in certain segments of the market that we've seen since the election. But positioning is just one part of the puzzle here. And the election result notwithstanding, we had some pretty strong drivers for this equity bull market, and we think those are still in place. We've got durable economic growth, healthy profit growth, the Fed cutting rates, and a boom in AI. And some of the pro-growth aspects of a potential Trump administration just reinforce some of those positive elements. So yeah, look, I mean, we know stocks don't move in a straight line. Indices can be volatile. But in our view, the fundamentals and the drivers of this equity bull market still remain very firmly in place.
It's interesting because you do see the S&P 500, of course, just having a banner year, and you haven't really seen since the 90s a double 2 years in a row of 20% or more increases in the S&P 500. I know that UBS's target is really 6,600 when you look through the end of next year, but what is the potential here for the rate of acceleration, right? Trump was elected president. You saw the Trump trade. He is setting up his staff around him. And the question to me is, do the policies that they put in place drive the market higher than the rate you're seeing the market rise now?
Yeah, I think it's a great question, Sonali. So I think there's still a lot we don't know about the new Trump policies. And I think it's going to be important to draw a distinction from what we saw in Trump 1.0. Trump 1.0, we saw a very substantial reduction in the corporate tax rate. Obviously, Trump wants to reduce the tax rate further, but budgetary issues are probably going to make that challenging. So there could be, certainly will be a much smaller, if there even is a reduction in the corporate rate, because extending the personal income tax cuts, which expire, that's going to be very expensive to do, probably somewhere in the $4 trillion range over the next 10 years. So I think the Trump trade and the Trump policies, they have potentially echoes of what we saw in 2016, 2017, but those echoes are probably a little bit smaller, and we haven't even talked about the tariffs. And clearly Trump wants to pursue tariffs. That seems to be a core part of his belief. Robert Lighthizer potentially being appointed as U.S. trade representative. He's been a pretty hardliner. So yeah, there's definitely more. I would say there's more cross currents in this potential Trump administration than what we saw back at the first time.
If we do have big tariffs and mass deportations, we're also excited about the market. I think that we may overlook the potential for inflation to come back. Or is that just crushed? Is it just not a possibility that, shifting out 10 million workers and raising tariffs to 60% on China brings inflation back?
Yeah, Matt, I mean, some of these policies, would be inflationary. I think the question really is, what is ultimately implemented? And I think that's sort of a broader question across all of the policies. It seems like right now, the market, we're almost in sort of a honeymoon phase when, investors almost feel like we're kind of a kid in the candy store But I do think the reality of getting how all these policies fit together, that's going to take some digestion on the part of investors as we go into 25. But, in the more likely outcomes, Matt, I don't think we're going to be talking about a substantial change in the inflation outlook. Imported goods, let's not forget, it's not a huge part of the economy. Just goods in general are only about.
But worker pay is, David, and I just can't imagine if you take out multiple millions of workers that you don't get the labor market tightening up substantially.
Yeah, look, I don't disagree. I think the question is, what ultimately will be implemented and over what time horizon. But yeah, if we get a tightening of the labor market, certainly that could be a source of inflation. I would also let's remind ourselves, what really caused the inflation spike in the COVID period. A lot of it was related to COVID and the supply chain issues that we saw and this massive surge in goods consumption that the supply chain just couldn't handle. So I think any inflation firming is going to be very different than what we lived through a couple of years ago.
David, we thank you so much for joining us today. A lot to still digest. That is David Lefkowitz of UBS Global Wealth. Now coming up, we're going to bring you more on that Bloomberg scoop that activist firm Elliott is pushing for a breakup of Honeywell. A couple tough years, as Matt has been talking about, but now we're seeing a rise on the prospect of change. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
All right, right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Phillips Securities cutting Airbnb to a sell. The firm says that the stock's valuation remains expensive and that it trades at a premium compared to rivals such as Expedia. Next up, Carter's no longer a sell. That is according to Citi. The firm is raising its rating on the children's apparel company to a neutral, saying that the risk-reward is more balanced following the stock's recent slump. And finally, we have Morgan Stanley upgrading Viking Holdings to a buy. The analyst says that demand for cruises remains robust and that falling oil prices help too. The company reports next week, Matt.
I'm looking forward to that. Have you been on a cruise before, Katie?
No, I fear the ocean and rivers.
All right, very interesting stuff. I can't wait to talk about the cruisers when they report. Now, Bloomberg has learned that activist investor Elliott is taking a more than $5 billion stake in Honeywell. That would be the biggest investment Elliott has ever made, and it is pushing for the industrials giant to break up into two standalone companies, at least. Bloomberg's Brooke Sutherland helped to break the story. She joins us now. And Brooke, I find this a fascinating scoop. It's obviously moved the market significantly. What do they want to do with Honeywell, and are the leaders of that company receptive to Elliott's suggestions?
So they do have a new CEO at Honeywell. Vimal Kapoor has been there for a little over a year now, and he has been saying things about wanting to remake Honeywell's portfolio. They are spinning off an advanced materials business, but this remains a very complex company, especially in this day and age when we've seen so many breakups among the great industrial conglomerates of the past. Honeywell is really one of the few that has retained the sheer breadth of businesses that it has. It makes automation equipment, it makes warehouse robots, it makes parts for airplanes, it makes different additive materials. It's a very complicated company. And I think what's important to remember here is that there's nothing fundamentally wrong with Honeywell. It's actually a very, very well-known company, and it's known for being extremely efficient, but it's just so complex that it's really struggled to grow and gain attention with investors. And that's really what Elliott is focusing on here, that this is a company that's too complicated for its own good, and potentially taking that very valuable aerospace business and making that a standalone could create a lot of value.
Brooke, one line in this story really strikes me, and it's what they get out of the sum of the parts. The idea that you could have a share price upside of 51 to 75% over the next 2 years. What do we know, especially because there's a somewhat newer CEO in line here? How are they receptive, if at all, to Elliott's proposals?
Well, I think that some of the parts is really interesting, and you just have to look at some of the breakups that have happened recently, and particularly GE. That company did a three-way split. They did it in pieces. They spun off their healthcare business, and then earlier this year, their energy business. And I don't think even the best case scenarios that analysts could come up with could have envisioned the just rocket ship that GE stock price has been on since they announced this breakup. And their spinoffs have done fairly well too. GE Vernova, last time I checked, was the best performing stock among industrials on the S&P 500. And so I think when you look at that, that just shows you the value that can be created when you untangle these very complicated conglomerates. Because again, these are fundamentally very good businesses. It's just whether or not you can appreciate that when they're all shackled together. They tend to grow at different rates. They tend to have different capital requirements. They have different M&A needs. And investors don't think like that. They want to look at a very simplified story, and it's harder to get them motivated to invest in something complicated when there are more simple stories out there, like GE Aerospace, like, in the aerospace sector, like Howmet, like TransDigm. You just look at how well those stocks have been performing relative to Honeywell. Right. And I think that shows you what Elliott is really focusing on here.
Well, Brooke, we were talking about it at the top of the hour that spinoffs have been so high. You take a look at Bloomberg's spinoff index, it's at an all-time high. And to your point, the top holding in that index is GE Vernova, followed shortly by GE Healthcare and Constellation Energy. I'm curious, though, you've been covering industrials for so long. Do you think that we reach a tipping point where the cycle turns around and maybe we do enter an era where industrial conglomerates make sense?
Sure. So, I do think that we had a moment in time where maybe the industrial spinoffs went a little bit too far, and we were splitting hairs, and we were talking about, breaking up pump makers and separating out life sciences pumps from oil and gas pumps and things like that. And I think that didn't necessarily create a lot of value. That's not what we're talking about with Honeywell here, but you have seen, a bit of a shift in industrials in terms of at least looking for more balance, maybe not being so narrowly focused that their business is vulnerable to volatility in markets. And so what that means is maybe you don't just have an aerospace company, maybe you have an aerospace and defense company, or maybe you invest further down or further up in the supply chain, whatever that might look like for a specific company. You think about a company like Nucor, for example. They're a steel maker. They bought a garage door company a few years ago in terms of just trying to create more of a balance, less volatility in their earnings. And so I think you will continue to see more of that, but I don't think we're going back into the conglomerate structures of old where you had seemingly much more random configurations of businesses. I think that age is ending, as you see here with Elliott making this move at Honeywell today.
Brooke, we're so grateful for your time. Great scoop, of course, Honeywell moving on the news. Bloomberg's Brooke Sutherland, who knows everything about this space, really. Now, coming up, Donald Trump Jr. opts out of the White House and hops into the world of venture capital. We're going to talk about what he's looking at next in today's Wall Street Beat. This is Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a check on the stock market. About 22 minutes into this Tuesday trading session, you can see the S&P 500. The color is green, which means that we're at all-time highs, but really tepid gains here, just up about 0.1% on the S&P 500, on the NASDAQ 100 as well. Even the Russell 2000 coming back from some of its steeper losses. It was down about 0.6%. It's still in the red, but those small caps only down about 0.1% at the moment, Shonali.
And Katie, it's time now for the Wall Street Beat. Today, we're looking at Donald Trump Jr.'s jump into the world of venture capital. The president-elect's oldest son is set to join 1789 Capital, which is a venture capital firm that invests in conservative-leaning companies. Joining us on the phone now with more is Bloomberg Wealth's Amanda Gordon, who's in Palm Beach, Florida, reporting on the latest in the Trump transition. And it's really interesting. He's not the only one in the Trump family orbit who has gone into investing, but we know that Donald Trump Jr. in the past has played a very critical role next to his father in the world of politics. Amanda, explain the move here.
Well, one of the things that Donald Trump Jr. did during this campaign season is be really out there doing podcasts, making speeches, connecting with a really younger donor with a hook to Silicon Valley and the tech scene. And so it feels like a natural evolution if you've been following him, if you saw him, as I did, on the final night of the Republican National Convention, presiding at a booth in a room filled with investors from Founders Fund and the whole scene there. David Sachs saddled up to the booth at one point. So this seems like a natural step, and I think it's just worth saying that while right now we as journalists are focused on who will be staffing inside the White House, this moment also creates a lot of market opportunities. America has just given us a signal of where consumers are moving, what they're thinking, what they want to consume and read, and the American products they want to buy. And that's where Omid Malik, who runs the firm, and where his friend Donald Trump Jr. will be focusing.
Yeah, I mean, it's also fantastic if your dad is the president to be able to help these companies thrive and grow, right? It just gives you a huge leg up. So do you know what kind of companies he's going to be investing in?
Well, media has been one area that the firm has already dabbled in, making an investment in Tucker Carlson's concern. And also, as I signaled, products that are made in America is an area of interest. So these things are happening, as we speak. There are rooms where there are interviews for posts like Treasury, and there are rooms in Las Vegas right now where people are pitching. Donald Trump Jr. made his announcement at a conference organized by the Rockbridge Group, which is conservative-leaning donors, and he made this move. And I think because he's already such a public figure, he's going to naturally attract interest and opportunities. They're going to come to his door.
All right, Amanda, thanks very much. Amanda Gordon there reporting from Palm Beach, Florida. And I imagine 1789 is not a reference to the French Revolution, as you would instantly think, right? But to the election of George Washington and the adoption of the Constitution.
That's probably fair.
Yeah.
Really interesting to see this move by Don Jr. But of course, all eyes trained on when we're going to get the Treasury Secretary pick. We were talking yesterday about how Scott Bessent is leading in the betting markets. Of course, this all comes up to one man, but you're seeing plenty of key advisors to Trump also back Bessent as well. So maybe a decision coming in the next couple days.
Well, that would be the biggest deal here, too, because you know that he has been so close to him when it came to the Economic Club of New York speech. I know you and I were both there. Critical person behind his policy. Let's see how the market takes it, Matt.
All right, don't miss, by the way, later today, Shonali's exclusive interview with the CEO of Citi, Jane Fraser. That's at 2 p.m. Eastern.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, you. We can't wait to see what you've got. Let's get funded now.
General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding.
Minutes ago, we asked the live audience on X to submit a few requests for what they would like us to try out here. So I will take a couple of prompts. Okay. Bot Gaskar wants to know if GPT-4o is capable of real-time translation. Mark, you want to try this one?
Sure. Yeah, let's do it.
All right.
Yeah.
I speak Italian, so we can just do English Italian.
Let's try to do English Italian. Sure, let's do it. Hey, ChatGPT, how are you?
I'm doing fantastic. Thanks for asking. How about you? How's your day going?
I'm doing great. So I would like you to function as a translator. I have a friend here who only speaks Italian, and I only speak English. And every time you hear English, I want you to translate it to Italian. And if you hear Italian, I want you to translate it back to English. Is that good?
Perfetto.
Mark, io mi chiedo se le balene potessero parlare, cosa ci direbbero?
Mike, she wonders if whales could talk, what would they tell us?
They might ask, how do we solve linear equations?
Potrebbero chiederci come risolviamo le equazioni lineari.
Sicuramente sì.
Certainly yes.
Great. Looks like it works.
All right. So the next one is from Burrito John 78, who asks, can you tell what you're feeling just by looking at your face? Barrett, you want to give this one a try?
Absolutely. Let's try it out. Hey, ChatGPT.
Hey there. What's up? How can I brighten your day today?
Okay, yeah, so I'm going to show you a selfie of what I look like, and then I'd like you to try to see what emotions I'm feeling based on how I'm looking.
Sounds like a fun challenge. Go ahead and show me that selfie, and I'll put my emotional detective hat on.
Okay, so here's me. So what kind of emotions do you think I'm feeling?
It seems like I'm looking at a picture of a wooden surface.
Oh, you know what? That was the thing I sent you before. Don't worry, I'm not actually a table. Okay, so take another look.
That makes more sense. There we go. It looks like you're feeling pretty happy and cheerful, with a big smile and maybe even a touch of excitement. Whatever's going on, it seems like you're in a great mood. Care to share the source of those good vibes?
Yeah, no, the reason I'm in a really good mood is because we were doing a presentation showcasing how useful and amazing you are.
Oh, stop it. You're making me blush.
Amazing. Well, that's it for today on live demos. As you can see, this just feels so magical, and that's wonderful. But we also want to remove some of the mysticism from the technology and bring it to you so you can try it for yourself. So over the next few weeks, we'll be rolling out these capabilities to everyone. Today has been very much focused on the free users and the new modalities and new products, but we also care a lot about the next frontier. So soon we'll be updating you on our progress towards the next big thing. And before we wrap up, I just want to thank the incredible OpenAI team, and also thanks to Jensen and the NVIDIA team for bringing us the most advanced GPUs to make this demo possible today. And thank you all very, very much for being a part of this today.
He was upset at his divorce property settlement. But as I've said, he is now in a coma and unable to be questioned.
Crews northwest of New York City having a difficult time getting a handle on a wildfire straddling the New York-New Jersey border. It'll be windy today. Rugged terrain isn't helping. Fire Service Commander Christopher Franick.
Hard to get equipment in there because some areas it's too steep for bulldozers to go to. So it is somebody on the ground digging fire line, choking on smoke and dust, trying to suppress this fire with manual labor.
Nominations for the Songwriters Hall of Fame are out. Janet Jackson, NWA, and Eminem all in contention for the class of 2025.
Now back in the days of Oak Me, right around the time I became a dope fiend, ate some coke.
Sheryl Crow, George Clinton, and the Doobie Brothers among the other performers nominated as well. This is CBS News.
Terms and conditions apply.
An oil giant has won an appeal against a landmark Dutch climate ruling.
Shell had challenged the 2021 ruling that it must reduce greenhouse gas emissions by 45% by 2030 and respect human rights. Shell argued that this was a matter for politicians, not the courts. Judges found that while protecting people from the effects of climate change is a human right, forcing Shell to cut its emissions will not mitigate the global problem. The environmentalists who brought the case said the decision hurts, but vowed to continue their fight against what they call the major polluters. The decision can be appealed. Lauren Comato for CBS News, Amsterdam.
And that judge in New York, considering Donald Trump's hush money conviction, has just postponed a decision on whether to undo it. Juan Marchand, the judge, had been set to rule today. Instead, he's told Trump's lawyers he will delay the ruling until November 19th. That's next Tuesday. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming on YouTube, so head over to youtube.com, search Bloomberg Podcast, and that's where you will find us. Alex Steele out today, sitting in for Alex. Jess, good morning.
Going to be another fun week. We'll see if the S&P 500, after hitting 51 records so far this year, if it can hit 52.
51 records this year?
Right, that's correct.
Wow.
But so it actually just turned marginally lower, so back below 6,000, but we'll see if it can get 52 today.
Yeah, I like that 6,000 number. Nice round number. Drew Redding's going to join us, Bloomberg Intelligence home building analyst. We get some good numbers out of Home Depot. We'll break them down. Emily Lavelle, portfolio manager at Thornburg Investment Management, will give us her markets call. Mike McGlone, Bloomberg Intelligence senior commodity analyst. We're going to talk to him about oil and Bitcoin. We were pushing up against 90,000 for Bitcoin.
That's right. Also, Tom Keene was just talking about how Dogecoin has a market cap of about $53 billion. That's more than 303 companies in the S&P 500. He just posted it on LinkedIn.
Oh, my goodness. The Doge. Tom Keene back in the markets. He'll be back tomorrow for Bloomberg Surveillance. Right now, let's kick this whole thing off with Lisa Mateo on a Bloomberg Business Flash.
You got it. This Bloomberg Business Flash brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit IBKR.com/forecast. Get started today. All right, well, we've got little movement in stocks. This is after a few milestones. Yeah, the S&P 500 closed above 6,000. The Dow Jones Industrial Average finished above 44,000. Let's see how it's shaping up right now. We have the S&P 500, little change, down 5 points at 5,995. The Dow down about 0.1%, 82 points, 44,208. The NASDAQ, little change, down about 8 points at 19,291. The bond market, yeah, back in business after the holiday. We have the 2-year yield, 4.32%. Up 6 basis points. The yield on the 10-year, 4.37%, and that's up 6 basis points. To currencies, the dollar stronger. It's heading toward its highest since November 2022. We have the Japanese yen, euro, British pound weaker, and Bitcoin, like you said, it was surging near 90,000. It's now down about 1% at around 87,000. Crypto-linked stocks, they were erasing earlier gains. Now we have a bit of a mixed bag. We have MicroStrategy. They're up about 1%, but Coinbase is down about 1%. To earnings, we go Home Depot. Their shares up more than up about 0.5%. Raised its outlook, said bad weather, things like hurricanes, it really helped boost those DIY sales, especially outdoor projects, and also warm weather that helped with the sales of products like grills. Then Shopify really soaring up 24%. Third quarter results beat expectations and gave a strong outlook on top of that. And finally, Tyson's Foods. They forecast higher earnings in 2025 that turn around the chicken business. Rising demand for prepared foods, that really offset those losses in beef. Its shares up about 9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Alex Steele. Alex will be back next Monday. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio and streaming live on YouTube, so check out youtube.com, search Bloomberg Podcast. Market Drivers today is brought to you by Wells Fargo Advisors. Consider Wells Fargo Advisors Financial Network, where you can run your business with true independence, supported by unrivaled resources. Learn more
at WFA.com/resources. A little bit of red on the screen here, not going to oversell it. We've had some just ripping markets over the last 4 or 5 trading sessions, so a little bit of a pause here today. Carmen Reinke joins us here. She covers all the equity markets for Bloomberg News. She joins us here in our New York City studio. Carmen, what are you looking at?
Yeah, so the first thing I'm looking at today is Honeywell. That's ticker HON. Shares are up about 4.5% right now. What happened is Elliott Investment Management said this morning that it's built a more than $5 billion position in the industrial giant, and this actually confirmed an earlier Bloomberg story on the position. Obviously, this is an activist investor. It said that it wants to separate the company into 2 standalone firms, one that would be focused on aerospace while the other focused on automation. This is interesting. I feel like some of these sort of bigger conglomerates, we've actually seen a little bit more of the idea to break them up, to spin off certain units. They're actually like much easier for investors or markets to value them. So interesting that Elliott's pushing for that here. Honeywell's lagged sort of the other industrials names.
So another one I have to point out, and I know you're looking at, is Shopify. So Shop is the ticker symbol, up 25% today, on pace for its best day since May of 2015. What's going on?
Yeah, well, and this is also actually a Canadian company.
Right.
It trades both here and in Canada, and it is consistently, I think over the last 2 years, been one of the best performing stock on the TSX. So just a little shout out.
It also had cost-cutting efforts that it did well ahead of, say, the big tech giants, even before like Meta and some other companies like that. So it's really benefited from that, right?
It has, yeah. So what shares are up on today? Third quarter sales beat estimates, and the company gave a strong outlook that indicates that market share growth will continue into next year. It also seems to sort of switched its strategy. It was sort of trying to build out new products and services for existing customers, and now it's going after bigger customers sort of instead, or just focusing more on that. So like one of the retailers, I guess, that it's signed on its platform is Toys R Us. So just having those, bigger retailers driving.
Have either of you ever used Shopify?
I have. It makes it so
have
easy.
not.
I have not either.
Oh my gosh, it's like up there with Apple Pay on like things on your phone that make it so easy to spend money.
So you do?
I've used it. I have.
Really? Okay.
Maybe I shouldn't. Easier ways to spend money. I feel like I'm trying not to do that.
I mean, this company, I didn't realize how big this company is. I mean, it's got $140 billion in market cap. Stock's up 40% this year, up 80% over the trailing 12 months. Just ripping.
It really is.
All right.
Yeah. Yeah, and the last one that we're looking at today, TSN,
consumer
Tyson
staples.
Foods. Consumer staple, this is not in my wheelhouse. Jess knows that I'm a vegetarian. But
I keep accidentally always bringing up going out and eating steaks, and I keep forgetting that she does not do this. Texas,
yeah. Well, I grew up in Wisconsin, so it doesn't really
Texas, Wisconsin.
But so the company beat fourth quarter estimates. It also said that it raised its adjusted operating income estimate for fiscal 2025. The interesting thing here is that a turnaround in chicken helped offset losses in beef. The company beef is the company's largest unit. There was a $71 million loss in the quarter, but apparently chicken did really well, and also plunging prices for corn and soybeans have made it easier to feed animals.
Oh, good stuff.
Interesting.
Who knew? We'll talk to Mike Malone coming up. I mean, here's a
Miami Mike.
Miami Mike. He started out on a farm somewhere in the great Midwest, not sure where. Carmen Reinke, thank you so much for joining us. Carmen Reinke, she covers all the equity markets for Bloomberg News. We appreciate getting a few minutes of her time. What would you like to hear on Bloomberg Radio? Help me make shows like ours even better by taking our Bloomberg audience survey. Visit youtube.com/Bloomberg Podcast and click the link in our profile or community section to take the survey, which is hosted by our partners over at Material. Fill it out now at youtube.com/Bloomberg Podcast. Home Depot put out some numbers. Apparently some of the hurricanes have caused people to have to get a bunch of supplies to repair their homes, and that kind of that worked out well for the folks at Home Depot. Drew Redding, home builder analysis for Bloomberg Intelligence, joins us here. Drew, talk to us about Home Depot, I guess, raising its outlook here. What did you hear from the company?
Yeah, solid quarter, a beat and raise on same-store sales, which is the key metric everybody pays attention to. It looks like they got a little bit of benefit from warmer weather across the country. And at the same time, they also benefited from some of the recent hurricane activity that we had in the South. They mentioned about a $200 million sales benefit, or 55 basis point impact to same-store sales. But I think that the main takeaway is that the underlying trends of the business really haven't changed all that much, despite the raise to the full year guidance, which really just reflects the outperformance this quarter due to weather. Their customers are still battling with the cumulative impact of inflation over the last several years. One thing they continue to call out is general economic uncertainty. And you also have the housing market, which is extremely depressed. If you look at resale volumes in the existing home market, we're at the lowest levels in 14 years. So, it's hard to get a turnaround in the home improvement retailers until we start to see a little bit more activity on the housing front.
And we're also going to have Lowe's earnings next week, as you know. It's interesting, just looking at Home Depot's stock, ticker symbol HD, it's down about 0.5% right now. It's actually up 17% year to date, but it's still underperforming Lowe's. That's actually up about 22%. Why the divergence here? Because we do know there's some differences between both companies.
Yeah, I think the primary reason for the outperformance just has to do with kind of a technical situation where Home Depot's valuation premium over Lowe's kind of got a little stretched versus history. So part of that was just playing catch up. Lowe's is also viewed as more of a turnaround story than Home Depot. So they're doing some company specific things on the margin side, on the cost takeout side, that are kind of lifting their margins up to where Home Depot's are. So I think part of it is just where the multiples were between the two companies, and part of it is investors placing their bets on a turnaround story with Lowe's.
And just remind us the differing customer bases, Lowe's versus Home Depot. Is one more professional than the other?
Sure. So Home Depot is about 50% DIY, 50% professional contractor. Lowe's is about 75% DIY, 25% pro customer. That mix has really been a benefit to Home Depot because, as we know, the professional contractor has held up relatively stronger than the DIY market. They're still operating backlogs over the last several months, so they continue to have that stream of business. Now, it's certainly, we're not seeing those big ticket projects being replenished at the rate they were over the last couple of years, but they're still working with pretty strong backlogs. Home Depot has made a point of emphasis to go after an untapped market within the broader professional contractor space, and that's really in the market for larger, complex projects. They peg it at about $200 billion, and it's really what they want to do is become a one-stop shop for contractors who have historically gone to multiple suppliers for their products. They want to bring all that in-house and offer all the capabilities to those contractors that they're getting at the independent level.
We only have about a minute left, but I was curious, if you're on the earnings call for them, what would you want to ask their C-suite executives?
So it actually just wrapped up, and I think the biggest takeaway is really, what we need to see on the existing home sales front in order to see a broader rebound in the home improvement space. And it's not just the impact rates are having on housing turnover, but it's the impact that rates are having on big ticket discretionary products. So really the color that they provided in terms of what they need to see on rates in order to unlock that big ticket discretionary category is what I think a lot of people are paying attention to. And until, we see something probably in the 6% range, we don't think you start to unlock sales or that tappable home equity that's built up over the last couple of years.
Yeah, mortgage rates are going the wrong way. Mortgage Bankers Association 30-year fixed rate 6.81%. That's the highest it's been since kind of back in the summer. So no bueno if you're looking to refinance a mortgage there. Drew Redding, home building analyst for Bloomberg Intelligence, joining us from Princeton. Coming up, Emily Lovell, portfolio manager at Thornburg Investment Management. She's going to be in studio. Look at her thoughts on these markets. S&P 500 absolutely unched on the day. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about our consultative support and technology. All right, we've got stocks pretty much taking a breather. Investors weighing the potential policy impact of President-elect Donald Trump's cabinet picks. Shares of Trump Media and Technology right now, they're down about 8%. They're taking a breather too. We have the NASDAQ, little change, down about 5 points at 19,293. The Dow down a 0.1%, 68 points, 44,223. And the S&P 500 down a 0.1%, 6 points at 5,995. We have the 2-year yield at 4.31%. That's up 5 basis points. The yield on the 10-year 4.37%, and that's up about 6 basis points. To commodities, oil, we have Brent crude up about 0.8%, $72 a barrel. WTI crude $68 a barrel, and that comes as OPEC cut its oil demand growth forecast for this year and next for a 4th month in a row. To earnings we go. Shares of Hertz, they're down this morning about 2%, and this is after losses a little bit wider than expected. Again, that's due to its failed bet on Tesla EVs. And shares of Ticketmaster owner, concert promoter Live Nation, they are up about 4% and reported better than expected quarterly earnings. Big summer concert season. It said expects more growth into 2025. And finally, Nissan stock jumped the most in 15 years. Its shares now down 12% in Japan. That's after an activist investor took a 2.5% stake. For on-demand news 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. That's the internet. So head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Do you believe that they allow people to manage money in Santa Fe?
I believe that.
Mexico? Can you believe that?
Hey, they let us do it in Texas, so why not?
Emily Lavelle, she joins us. She's a portfolio manager. Thornburg Investment Management. They are based in Santa Fe, New Mexico. It's a thing. I confirmed it. It's really the case. They got a lot of money, $46 billion in client assets based in Santa Fe. Emily, you look at international growth.
Correct.
Okay. Is China, it's international, but is there growth? How do you guys think about China?
So, thanks for having me. We invest in companies, not countries.
Okay.
We're a concentrated portfolio. Most of the portfolios at Thornburg are. And, we do deep fundamental analysis on all the companies that we have in the portfolio. So I think that there are selective, really interesting opportunities in China. We have been staying away for the last couple of years on policy uncertainty, on growth concerns. As you mentioned, growth has been, by and large, GDP growth has been very weak in China. You've had price deflation. But, we see early signs from some of the stimulus measures announced from September through the end of October that the Chinese government is really focused on bringing growth back to the economy. They see it as a priority, obviously. And we do think, therefore, that there are selective places to invest there. And we think it's really important for the global economy. I mean, it's the second largest economy in the world. 20% of Apple revenues are there.
Yep.
So we do see opportunity. And look, when you're priced at, sub 10 times earnings, it doesn't take much. Expectations are very low. And so we want to be very mindful of that.
I want to talk to you about positioning, in particular in the U.S., just because Bank of America, as you know, they put out their fund manager survey this morning. And each month, they always have interesting statistics in there. And so something that really jumped out was that U.S. equity positioning had actually surged to an 11-year high on the back of Trump winning the U.S. presidential race. And I was curious, where are you seeing particular points in the equity market that look stretched, whether it's an index level or a sector level? And how are you talking to your clients about that?
Well, we're international investors, so we're going to be biased to begin with. But look, we've been saying this for a number of years. I think it continues to be true. U.S. equity markets are stretched, and after the recent move we saw in the last week, look, very little about the fundamentals has actually changed. You might get some deregulation. That could be a boost to earnings growth in certain sectors of the U.S. economy. But there are other policies that the Trump administration is putting forward which are inflationary, they're contractionary, and so I'm not convinced that move higher is going to be sort of fulfilled with greater EPS growth in the next couple of years. So when we look outside the US, we find really interesting opportunities to invest in businesses that are exposed to the same sort of structural growth trends of the companies that you see here in the US, but they typically trade at a lower valuation.
And something else I'm curious about is emerging markets, because some of them are more commodity driven than others. So which ones do you see positioned more well in 2025?
Again, companies, not countries for us. Positioning into 2025, we're really focused again on these long-term structural winners. Latin America, for example, we've got, I call it the dynamic duo, Mercado Libre and Nubank, because, you've got Mag 7 here, and we talk about the Fantastic Five in Europe as well. But look, these are businesses that are going to win regardless of the environment. I invested in emerging markets for a good part of my career, and you just have to be focused on the companies because the macro is so volatile. You've got to be able to find companies that are in control of their own destiny.
Shopify having a ripping day today.
Indeed.
52-week
We love
high,
it.
up 25%. You guys own it. Why do you own it?
So Shopify is a perfect example of what I was just talking about, a company that is in control of its own destiny. This is a consumer-focused company, the majority of its business in the US, but a growing presence outside the US as well, obviously a Canadian-based business. Shopify has been taking share from sleepy incumbents, Magentos, Salesforce, big software providers where e-commerce services were just a small portion of what they offered. Shopify has been laser focused on that. They've been taking share with better product rollouts. They've been moving up market. They used to be really focused on this SMB segment. Now they're moving into enterprise and they're winning. So, we saw top line growth was 26%. The market was looking for 20. Free cash flow margins of 19%. So they're achieving this balance of continued growth and share gains and profitability. And that's exactly what we want to see. And we believe that a business like Shopify, because they have this better value proposition, is going to continue to grow and take share regardless of the consumer environment.
Talk to us about those Chinese internet giants that you're looking at more selectively, and then how in turn that could end up impacting more of those international consumer type names.
So the Chinese internet companies are really interesting. I mean, look, if you look at companies like Meituan, which is a food delivery business in China, Meituan has actually been growing earnings throughout the last 2 years and really delivering on a promise to balance growth and profitability. And so, on a fundamental basis, and again, as fundamental investors, we believe that's really what's going to drive stocks in the long term is can you grow your earnings, can you grow your EPS, and can you generate a return above your cost of capital? And we see with a business like Meituan that they have been able to deliver that. Other companies, JD, Baba, there's been a bloodbath of competition in China over the last few years. We are looking for early stages of how that might shake out. If these companies are going to try to focus on their lanes and focus on that growth plus profitability. I really think what's going to drive an improvement for JD and Baba is going to be the macro dynamics. I mean, Baba, more specifically, has a number of assets that they can divest and monetize as well, which could be very impactful for total shareholder return. But that's a very China-specific part of the business. Now, the company in China that's really moved away from China specifically is PDD, which owns Temu, which many of us as U.S. consumers know. And again, that is just an incredible value proposition for customers.
All right, Jess, you could fill an ocean with what I don't know. I don't know anything about Nubank, and it's got a $75 billion market cap. How did I miss this? It's up 90% year to date. What is Nubank, and why do you guys own it?
So Nubank is a digital bank started in Brazil by a Colombian.
I use my app, my Wells Fargo app.
Yeah. You should check out the Nubank app. No, I mean, Nubank is an incredible business. Here's what Nubank's competitive advantage is. They are the low-cost supplier of financial services starting in Brazil, in Mexico, in Colombia, and they have taken tremendous share because they are offering a better value proposition to customers at a lower price. They've managed to maintain good asset quality as they've done this, which is always the Achilles heel of a bank, right? It's all well and good. You can attract customers, et cetera. You blow yourself up on lending. They've got a number of executives that are ex-Capital One executives, so really focused their early products on credit card and just offering great value for the consumer. Just to give you a sense, they've got over 100 million clients in Latin America now. In Mexico, where they're just starting to grow their lending products, half of Mexicans don't even have a bank account. 85% of them don't have a credit card. This is a classic market that has been underserved by sleepy incumbents. A low-cost supplier comes in and says, you know what? We're going to disrupt this with a better product that customers are going to love. And they are maniacally focused on their customer experience and product development. And I think it's a tremendous business. I think it's a tremendous business that has runway to compete in a number of different markets outside of just Latin America in the long run.
I have to ask you about chip stocks and how you're positioned there, because, I mean, we know that's been such much fervor over the last year.
There's been a little bit of a fervor and then a little bit of a retracement in the last couple of quarters. We remain invested. We're long-term investors. Look, we think, AI is a platform shift that is potentially one of the more impactful ones that we've seen over the last 40 years, really since we moved from mainframe to PC. And the scale and the implications of it are, I think, still underestimated by the market. The way that we are invested in this space is still through the picks and shovels. It's the semiconductor industry. And the reason for that is that we still don't have a clear picture of what the AI applications are going to be on the top there. It's tough to invest as a public market investor in that space anyways. We also see incredible benefits of scale in this industry. So the big are going to get bigger. So your semiconductor manufacturers, designers, the cloud service providers that are actually buying the GPUs. And the two interesting points that I think are continue to warrant staying invested is that you continue to see CapEx growth, but it's sustainable, right? This is all self-funded by the cloud service providers. This is not like the 2000s where you've got companies that are spending 2 to 3 times their operating cash flow. This is well in line with their historical spend, and utilization levels are 99%, and so they're getting a return on this investment. So that's really where we see, and outside of the U.S., this is a global value chain. TSMC, ASML, Disco, AMD, obviously in the U.S., but this is really where the best quality businesses, the winners globally, are actually, a lot of them are outside the U.S.
Interesting. Emily, thank you so much for joining us. As always, Emily Lavelle, she's a portfolio manager. One of the smarter people, young people that we speak to. I'm just blown away every time. Portfolio manager, Thornburg Investment Management, somehow ensconced in Santa Fe, New Mexico. I don't know why she's not riding the subways here in Manhattan like with the rest of us down in the subways. But anyway, S&P 500 off 5 points. The Dow off 100 points. NASDAQ up 15 points. So not a lot of movement out there. Maybe the market's taking a little bit of a pause here after the big rip we've had since the elections. Coming up, your friend Miami Mike McClone, Bloomberg Intelligence Senior Commodity Strategist. Let me get his thoughts on this Bitcoin thing. We were pushing up against 90,000 earlier this morning. It's been a heck of a move. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, stocks kind of pausing their gains. This is over signs that the rally has left valuations overextended. Right now, we've got a mixed bag. We'll start with the NASDAQ. Little change, up about 9 points at 19,308. The Dow down 0.2%, 107 points, 44,181. The S&P 500, little change, down about 5 points at 5,995. We have the 2-year yield at 4.32%. That's up 6 basis points. The yield on the 10-year, 4.37%. And that's up 6 basis points. I have to point out Bitcoin right now, it is down to about 86,000. It was nearing about 90,000. Federal Reserve Governor Christopher Waller saying he sees no strong case for supporting the creation of a digital dollar or U.S. central bank digital currency. To economic data we go. U.S. small business optimism rose in October, the weeks before the election. The index matched the highest reading since early 2022. Tomorrow, we get October's reading on Consumer Price Index. Thursday, it's on to PPI, followed by retail sales on Friday. We have shares of Bayer down about 12% in Germany, plunged to the lowest in 2 decades. The company cut its profit outlook for the year, said earnings will probably fall in 2025. And shares of Tesla down about 1.5%, and that's after climbing 9% yesterday. Comes as that the stock has advanced over 39%, adding more than $300 billion in market cap since the election. And finally, consider a breakup. We have Honeywell up more than 4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio, and we are streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast. That's where you will find us. Bitcoin, earlier in this session, was pushing up $90,000 per token. We're now at just under $87,000 per token, but weren't we just at like 60,000 a week ago or something?
So in the last 10 sessions, it's rallied 27% through yesterday's close. So there you go.
All right, I'm blaming Miami Beach for that. Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. He's down there in Miami. Mike, is this a trading technical thing? Is it overdone? What do you make of Bitcoin these days?
I think the best answer is yes. There's a lot of that going on. The key thing is Fed is ETF flows. Right now, Bitcoin, just as of yesterday, just crossed the threshold of 100 billion in total ETF holdings. To put that in context, a year ago it was about 8 billion. So the launch of US ETFs has brought into the mainstream, has really kicked it in. And also to put that into context, total holdings of gold ETFs are around 230 billion. So Bitcoin's almost halfway there, and it's only been less than a year of actual physical ETFs. So there's a lot of physical buying. We all know about the diminishing supply. And right now it's a bit of animal spirits. What I'm concerned about is you look at the correlation of Bitcoin, the S&P 500, the 60 days, it's the most ever on the way up. So the fastest horse in the race is leading everything up. And remember, the world changed a week ago when President Donald Trump was elected. Remember, in first Donald Trump's administration was really pushing against crypto. It was bad for the dollar. Now he completely flipped, and he's making the Bitcoin and the crypto people very happy.
So Bitcoin has been trading more like a leveraged version of beta than a digital version of gold. I know that's what you were writing about too. What do you think this could tell us also maybe more broadly about U.S. equities when you have a big run like this in the crypto space?
Well, it's catching up. So it pumped early in the year when the U.S. ETFs were launched. It pumped up to around 63 or 73 and then went back down to 50. And now with this paradigm shift of the new administration be completely favorable, probably going to get rid of the old SEC chairman, Gary Gensler, and have one that's more favorable. So it really shifted the narrative in this space towards positive inklings and positive regulation. So we have those animal spirits going. The question is how much further. And I'm glad you mentioned that, because I look at Bitcoin as it basically trades 3 times the volatility of gold and S&P 500. Now, 5 years ago, it traded almost 9 times the volatility. So its volatility is declining, but right now it's in that stage that, oh boy, we have a complete flip over. The administration's positive. We're seeing massive buying. Everybody's looking at 100,000 as the next key resistance. A lot of people are saying by inauguration. I don't really know for sure if it's going to get there. But the key thing I want to point out is that what I could say is Bitcoin will do fine as long as the stock market goes up. We have not seen a big test yet of stock market going down and Bitcoin going going up, and it's a much higher volatility. So it tends to be a leading indicator. And again, it trades 24/7. So during the even this weekend, a lot of times last weekend it pumped up almost 10% on just over the weekend.
Who's the marginal buyer of Bitcoin here, Mike? Do we think it's just the retail investor via his or her ETF?
Right now it is. It's that allocation of capital, Paul. People are telling me, oh, you just got to get off zero. And by getting off zero, maybe 1 to 2%, and that's what's happening on a pretty significant scale. And people look at it as, okay, if I can hold 100 units of, say, the NASDAQ or S&P 500 and put in maybe 1 unit of the Bitcoin, I can actually have the same type of upward trajectory with less risk. I can sell more of those higher, the lower volatility assets and buy this, rapidly advancing speculative digital asset. But the risk is it still is very much of a speculative digital asset. Just right now, we're only a week away from this paradigm shift of President Trump's decisive election. And I was delighted to see him switch back over to favorable cryptos, because I like to point out is, on a one-day basis right now, a 24-hour basis, the #1 traded crypto is not Bitcoin, it's actually Tether, and that's the US dollar. So our regulators and our leaders are figuring that out. It's good to see that.
What do the technicals tell us about Bitcoin? What's resistance, what's support at this point?
Yeah, everybody's looking at 100 grand as kind of the key level. The key support is 70. That's kind of where it broke out from. So 70 to 100 are the key levels. And we all know it's Bitcoin. It can be quite, can make you lose your hair, as people and the viewers can see. I did that. But yeah, so 70 to 100,000 are key levels. After that, we'll have to see.
All right, for Alex Steele, I know she's listening. Talk to us about oil. Your dad got WTI crude oil down here at $68 a barrel. Is that just the expectation that we're going to drill, baby, drill?
I'll see at 56. It's just a matter of time. 56 is the average cost of production in the U.S. based from BNF, Bloomberg New Energy Finance. And every day that goes by, we stay above that level. You see rapidly increasing excesses of supply in the U.S. and Canada, decreasing demand in China, most notably in diesel. Diesel demand is declining in the U.S., in Europe, in India, China, and we see that it's the growing spare capacity out of OPEC. So crude oil, I think, is going to do what natural gas did. It had to get below its cost of production. It did that in Q1, and it's bounced. The grains have basically done it in just a matter of time. And what's happening with the potential for tariffs is you see the headlines in the terminal that China's potentially enemy #1 for Trump 2.0. This is really bad for that #1 demand force for commodities in the planet, which means we should do what's normal in commodities, get below that cost of production. That's why I point out, typically it's below 56 for WTI, and then I think it's put a pretty good ceiling just below 80. And question, what stops that? I don't know right now.
Switching gears and looking at precious metals, I know gold, you were pointing out, may actually have a foundation from a technical perspective, around 2,400 an ounce, on track toward 3,000. Talk us more about that.
So I like to reiterate what I've been saying for, I hate to say how long, a couple of years. It's a matter of time it gets to 3,000. The high this year is around 2,800. That was very expensive. It's just pulling back for good reason, the decisive election, the potential détente in global geopolitical risks, which is probably not going to happen. But the bottom line for gold, this is a bull market. It's bucking. It's backing up a little. The difference is we haven't seen that in the stock market in a while. They've been kind of going up tick for tick. On a one-year basis, gold's up about 33%, S&P 500 is about 37%. So it's just a question of what will drive it next. The bottom line is we have rising geopolitical tensions, and the #1 source of demand for gold has been central banks. ETFs are just starting to turn upward, but what I've been saying about gold is there's really not a reason for U.S. investors to buy it until we see that U.S. stock market tear and or rates to go down. But for now, maybe it gets down to 2,400. That would be a decent backup, normal backup in a bull market. Otherwise, it's still a bull market. It's just bucking a little.
Mike McGlone, great stuff as always. We'll talk pork bellies next time. Mike McGlone, senior commodity strategist for Bloomberg Intelligence. He's down there in Miami. I don't know how he got in Miami, but he's there.
He's a pretty sweet deal.
He's got a sweet deal. But you get to be Mike McGlone. You can do
That's
kind
right.
of whatever you want. He said, "Hey, I'm going to Miami." I said, "Okay, enjoy it. Have fun." S&P 500, we are down 7 points. The Dow is down 145 points. The Nasdaq's up 19 points. So kind of a mixed look out there. Coming up, Scott Levine, Bloomberg Intelligence senior energy services analyst. He's got a note out saying Trump 2.0 may lift oil services profits more than drilling. We'll talk on the stocks. That's energy coming up. This is Bloomberg.
is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Jess Metton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. We were just talking energy, oil prices with Miami Mike McGlone. We now talk to maybe some ways to play it for investors in the stock market, particularly oil field services companies, on what does that mean for in a Trump administration. I gotta think it's pro-energy, right?
And especially looking at the IPO market, we've seen a number of those oil and services companies start going public too this year recently.
Yep, Scott Levine joins us. He's a senior industry analyst at Bloomberg Intelligence, covering a lot of the energy stuff for us. He joins us here in our Bloomberg Interactive Broker Studio. He doesn't mail it into Princeton like some of his managers do. He's here in the financial capital of the world. Scott, talk to us about how you view your sector, oil field services, in a Trump presidency. What's the feeling when you talk to your companies?
Yeah, so I think there's a preconceived notion that Trump is good for oil and gas and bad for renewables. At a high level, I wouldn't necessarily disagree with that. However, if folks are expecting the drill baby drill mantra from 2016, 2017 to apply this time, I think it's a very different world now that we're looking at. And so while I do think he's supportive of activity in the marketplace, I think drilling activity really is much more a function of market forces and market dynamics, and they really just don't support that. And we can discuss that in some more detail if you like, but the world is very different than it was 8 years ago.
So walk us through where, if you were looking at where WTI Brent prices were at the time 8 years ago, and the landscape for oil, especially when you think about oil companies like Exxon, Chevron, and other ones, oil field service providers as well. And the difference is because their stocks obviously weren't performing as well as they had been, say, like 20 years ago when you'd look at the top 5, 10 companies, and they were usually at the top of that market cap list.
Yeah. So really, at the end of the first phase, the shale revolution, 2009 to 2014, oil was near $150 a barrel. OPEC got into, basically said enough with shale growth. We're going to fight for market share. And that prompted a significant recession in oil and gas in 2015 and 2016. And the rig count fell from 2,000 in the U.S. To below 500, and oil prices cratered, $35 a barrel. And that's kind of where we were sitting at 2016, which was when Trump got elected to his first term. And so that market stabilized then, and we did see a recovery in 2017 and 2018 with the drill baby drill mantra and a recovery from that massive recession. However, things did not work out as well from a profit standpoint as industry participants had hoped. And a lack of discipline on the part of market participants. The earnings did not follow the rig counts higher, and investors basically said enough with this undisciplined growth within the energy sector in general, and calling for more disciplined growth ever since, really.
So oil field services stocks, give us who are some of those names and how do they typically trade? What drives these stocks?
Yeah, so we're talking about Schlumberger, Halliburton, and Baker Hughes, the big three. And what drives them, frankly, is growth. And that's why they've been lousy performers really every year with the exception of 2022.
When everything else was terrible.
Yes, when everything else is bad. And that was the 1 year as an energy investor you'd waited your entire life for. And unfortunately, even though oil prices are still sitting at $70, $80 a barrel, the services stocks have reverted to form, basically. And so while they have been more disciplined, like the Exxons and the Chevrons of the world, they're increasing their dividends, they're buying back stock, and they're not pursuing growth at all costs. That is not resonating with investors, which tells you, Paul, that these are growth stocks, and that lack of growth or lack of drilling activity is holding them back.
So how may geopolitics end up increasing market volatility?
Yeah, so that's really more of an overseas story. And so obviously Trump has a very different playbook there than Biden did. And so if what we end up seeing here is, support for, in the Middle East, firstly, support for Israel and a more anti-Iran stance, okay, that could create some volatility within the region, obviously, and not just the imposition of harsher sanctions on Iran, which could weigh on production, but more importantly, if they support Saudi Arabia, there's more tension geopolitically. That's going to make for nervousness in the market, and that's really been one of the biggest factors supporting oil prices over the last year or so. The same holds true in Russia, potentially. If we see a less supportive stance for Ukraine, for example, and Russia is able to impose their will more and pump more oil and gas in that region, that could create some more uncertainty in Eastern Europe, where they try to wean themselves off Russian gas. So I think in general, if we see this type of strategy or foreign policy out of the Trump administration, it could create more uncertainty overseas, and these are global companies, to be clear.
All right, Scott, thanks so much for joining us. Scott Levine, Senior Industry Analyst. You cover the energy space for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio. Just looking at Schlumberger, just for example, looking at the stock here, it's up by about 1.3% today, but it's down 14% year to date, down 15% over the trailing 12 months. So no real love for the energy spot, underperforming the broader market.
And actually looking, I had mentioned the IPO kind of space earlier. We've actually seen a flurry of IPO announcements from those U.S. oil and natural gas firms. So actually, Colorado-based Peak Resources is set to actually go public too. And you have some other ones like Infinity, Hornbeck as well have filed IPOs of late. So you're seeing more coming to the public market here, Paul.
All right, very good. We'll see. We've got WTI crude oil, $68 a barrel. BNEF is saying cost is like $56, so you're still kind of making some money pumping the oil out. I'll go down to Texas, put a hole in the
We'll
ground,
go down there
see
with
what I can do. See what I can do. S&P 500 off 13 points. The Nasdaq off 25 points. So not a lot of movement here in the underlying indexes. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we have some drama here in the Bloomberg Interactive Broker Studio. Charlie Pellet comes in and all hell breaks loose. Norma Linda's going to join us. She's going to tell us what's going on in the stock market. Ira Jersey, Bloomberg Intelligence. He's going to tell us what the Fed's going to do. Aaron Rutkoff, executive editor of Bloomberg Green, on the Bloomberg Big Take story entitled "The World's Best Hope to Beat Climate Change is Vanishing." So we got a lot coming up in this hour. And again, we got the markets kind of selling off just slightly on the margin. We'll get all the latest coming up. We'll do that with Charlie Pellet in the Bloomberg Business Flash.
Hi, thank you very much, Paul Sweeney. Coming in like a wrecking ball. We have got the Dow, the S&P, NASDAQ. All of a sudden, a lot of red on the screen right now. Not just red on the screen, but very close to morning lows on the S&P. Right to the numbers. Here's where we stand. The S&P down 12. Drop there of 0.2%. Dow Industrials now down 120. Decline there of 0.3%. The NASDAQ Composite Index down now by 20. A drop there of just about 0.1%. The Russell 2000 Index leading us higher yesterday, slumping today, down now by 0.9%. Your 10-year 4.38%, with the 2-year 4.31%. Spot gold down $19 the ounce, continuing its slump. $25.99 on the precious metal, down 0.7%. West Texas Intermediate crude is also lower now. WTI at $67.87 a barrel, down 0.3%. And after that surge over the past couple of days, we've got Bitcoin at 86,543, down today by 1.7%. So the Dow, the S&P, NASDAQ, all in the red. Omar Aguilar is Chief Investment Officer at Charles Schwab Investment Management. And on surveillance this morning, he told us no question, it has been an absolutely intense week since the election.
We have seen markets clearly, enjoying the fact that it was a very clear victory. I think removing the uncertainty coming into the election, created just a very positive momentum into risky assets that we have seen it. And I think that has accelerated with the fact that the expectations going forward will be for, tax reductions, will be from deregulation that has a potential for positive impacts into GDP.
Elliott Investment Management has built a $5 billion plus position in Honeywell International and is pushing the industrials giant to pursue a breakup. Honeywell shares are up today on a down day for the rest of the market, up by 3.9%. Coming up, 2 o'clock Wall Street time, a Bloomberg exclusive as we sit down with Citigroup CEO Jane Fraser. Citigroup shares right now down by 0.3%. S&P recapping down now by 0.2% for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pella, thank you so much. We appreciate that. Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. The question is, what would you like to hear about more on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg Audience Survey. Visit youtube.com/Bloomberg Podcast and click the link in our profile or community section to take the survey, which is hosted by our friends over at Material. Fill it out now at youtube.com/Bloomberg Podcast. As Charlie was just reporting, a little bit of a sell-off here this morning, kind of hitting some of these intraday lows in the marketplace. Let's check out what's going on underneath the hood. Norma Linda, she covers the equity markets for Bloomberg News, and she joins us here in our New York City studio. Nora, what are you looking at?
Well, lots to keep an eye on, Jess and Paul. I'm looking at Live Nation. That's ticker LYV. We're seeing shares surging for the highest intraday level on record, up as much as 5.6%. And this is after the company reported AOI that was ahead of consensus expectations. That's adjusted operating income for those who don't know. And this is all based off of the outlook. A lot of people are saying that we should see an uptick in demand and that the slowdown in stadium attendance for a lot of these concerts should reverse. They're seeing confidence that growth can recover for more premium artist tours, with tickets sold for 2025 shows pacing up double digits. I don't know what artists you guys are fans of or if you have any upcoming concerts that you're hoping to attend, but it sounds like people are still out there and they're going for it. Me, I'm just waiting for Justin Bieber to go back on tour.
I unfortunately couldn't make it to Taylor Swift or Beyonce.
Right.
It's impossible to get tickets.
All right, here's the economics of the music business. The economics of the music business, I don't care if you're Bruce Springsteen down to the lowest act, really, when it comes down to it, the only way you can make any real money is touring. That's it.
100%.
And
He's always on tour.
yeah,
Bruce
I mean, you guys are
Springsteen.
72. So if you're anybody, you don't make it. I don't care how many records you sell, how many streams you have, how many. You don't. The economics aren't in your favor. The only way you get to keep most, if not all, of the money is to tour. And who's the #1 tour promoter in the world? Live Nation. And oh, by the way, when you go to buy your tickets, who do you buy them from? Ticketmaster. Who owns Ticketmaster?
That's right.
Live Nation.
The more you know.
We put that deal together back in the day, and it was phenomenal. It was actually originally a Clear Channel company, and then SFX Communications and a whole bunch of these entertainment companies kind of all got rolled up into one. Because back 20, 25 years ago, each town in America had 2 or 3 music promoters. Now you have Live Nation.
Right.
And so what they did over the last 20 to 30 years is they went to every town USA and they bought up all the promoters.
They picked them up.
Yep. And the government didn't even know what was happening.
And here we are today.
You go.
Shares up year to date, 37%. I also wanted to move on to some food. Tyson's Food, that's ticker TSN. This is the biggest gainer right now in the S&P 500. And the stock is seeing its best day since February of 2022. Now, this is after it beat earnings expectations, and apparently growth in its chicken segment is offsetting.
People are looking at chicken instead of beef.
Apparently so. We're not going for beef these days. We're going for chicken. And that is the second largest source of revenue for the company. And it did post some great results there. So we are seeing shares rallying today coming off of this news.
Yeah, interesting because we just got the New York Fed. They have their monthly inflation expectations for shorter, longer term horizons. They did see those improve slightly. They came down a little bit for the shorter and longer term. But then you also had the labor market expectations improve as well. So it's interesting there. Maybe hopefully we'll see some of those beef prices come down soon.
We surely hope so.
But who works in those chicken and beef processing plants? Aren't there a lot of illegal immigrants that work there? So I wonder if there's an angle there.
Oh, absolutely. We've been actually talking about that on the equities team as far as what it means for those types of staples companies that have manufacturing facilities or even hospitality type companies and in small cap companies as well, because a lot of that derived not even just with lower rates, but what it means for cheaper labor.
Yep. Interesting to see how that plays out. Okay.
I did want to wrap things up with Home Depot. That's ticker HD. So shares were earlier in the green, but they have shed a little bit. We're down as much as 1%. But the company did raise its outlook, especially after we were thinking about those hurricanes, they did fuel demand for the company and its products. It lifted its forecast for a key sales metric due to that increased demand that we were seeing. And it has seen an uptick in terms of people looking for its seasonal items, but we do know it still has been an overhang for a lot of people pushing off their home improvement projects, apart from John Tucker, of course.
Exactly.
But the rest of us are waiting until we do see those interest rates come down and it makes more sense for people economically to get back out here. But this is a really strong report for Home Depot, and we are seeing that trickling out into the broader sector.
All right, Nora, thank you so much. We appreciate that. Nora Melinda, she covers the equity markets for Bloomberg News, joining us here in our Bloomberg Interactive Brokers studio. All right, the Fed went 50. They went 25. I guess we're waiting to see what, if anything, they will do in December. Is that the next
December
time?
18th.
December 18th. We actually pay somebody to think about this stuff, believe it or not. And this guy, he's built a career out of talking about U.S. interest rates, and he's the best on the street, and we got him. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, what do you make of the kind of the feeling at the Fed these days, given some of the economic data that we are seeing, which is coming in pretty strong? We'll get some inflation data this week in retail sales, but how do you think the Fed is thinking about the world these days?
Yeah, so it was pretty clear last week from the press conference that Jay Powell was trying to gain back some optionality by saying, look, we're not on a preset course. It's nothing new. He didn't say anything particularly new, but I think he did open the door for the idea that the Fed is going to maybe skip a meeting. And it could be the December meeting. The markets say about a 1/3 chance that they skip the meeting. I actually suspect that it's probably a little bit closer to 50-50. But like you said, the inflation data that we get tomorrow, there is going to be another inflation report that they get right before their meeting in mid-December. Those two inflation reports and the next payrolls report are probably going to be the keys to whether or not the Fed decides to skip and then reevaluate if they're going to go in January, or go this time and then reevaluate a January cut or not.
Hey, Ira, we're going to have the SLOOS, the Senior Loan Officer Survey, coming out today at 2 p.m. Eastern. I feel like that was so much in focus, especially last year when we had the tumult for the regional banks. Maybe a little bit more under the radar right now, but especially when you think about the lagging impact of rates, what are you looking for in this report, and how might yields potentially respond to this?
Well, I don't think yields will respond very much to the SLOOS one way or the other, but I do think the Senior Loan Officer survey is very important in that it will show whether or not there's still and continue to be loan demand. And what surprised many of us, and quite frankly surprised me as well, is that how strong the consumer's been able to maintain spending. So when you look at retail sales and the like, and a lot of that has really come from debt finance borrowing. So things like car purchases and the like, and you have seen consumer credit continue to climb. I think that shows two things. One is, credit conditions are still relatively easy, even with interest rates significantly higher. And then second, and I think that maybe this is underappreciated, and I was actually just talking about this morning with my associate, Will Hoffman, is maybe, after the global financial crisis, the consumer delevered quite a lot. And now they have the capacity to continue to add debt to their, to be able to do some of their spending, particularly on big ticket items. So as long as people have jobs and people keep on getting, 3.5–4% year-on-year wage increases, spending can be maintained for even a little bit longer than most of us had thought possible.
Ira, what's happened? How is your market, the government bond market, how's that reacted or traded over the last week since the election?
Yeah, so we sold off on the Republican sweep last week. Since then, we've kind of fallen into this range, call it 4.2% to 4.5% on 10-year Treasuries. That 4.5% level is pretty important because if you break that, there's going to be a lot of people who are long that might get stopped out of trades. So I suspect that there's a lot of stops above that 4.5, and then the next stopping point be about 4.75%, 4.7% on the 10-year Treasury. But things have stabilized, and in fact, last week we had a very, very strong auction on on 10 and 30-year treasuries. The 30-year auction was the best in over a decade. So you had a very strong auction, and that just shows that there is demand as you get closer to 4.5%, and then there'll be another kind of group of investors that really will love 5% if they can get a 5% 30-year. So I suspect that there is a limit to how high yields can go unless the economy really reaccelerates significantly.
All right, I'm trying to refinance the mortgage on the Jersey Shore compound. So, Ira, if you could do something for me, I'd appreciate it. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, joining us from Princeton, New Jersey. We appreciate getting a few minutes of his time. The big take story here, we always focus on the big take stories. Today's on the environment here. The world's best hope to beat climate change is vanishing. To have a chance against global warming, key economies and industries need to hit crucial emissions targets by 2030. And guess what? They are far off track. So our next guest is going to kind of walk us through kind of what's going there. Aaron Rutkoff joins us. He's an executive editor for Bloomberg Green. He joins us via that Zoom thing from the COP29 UN Climate Summit in Baku, Azerbaijan. I'll see it when I believe it here. Aaron, thanks so much for joining us. I have no idea what time it is over in Azerbaijan, but I appreciate your time here. Talk to us about this article, this big take story here about 2030 and trying to hit crucial emissions targets by then. Where are we?
Yeah, so, it's part of what the world does when it gets together at these UN climate summits. There's an expectation that we'll be announcing big goals, and that's been going on for decades, and especially since the Paris Agreement in 2015. So what my team did this week to mark the start of this latest UN Climate Summit was take a look at these intermediary goals that have the end of the decade as their target. So we're halfway through the time period, which allows us to get a pretty good sense of how things are going, and pretty much across the board, even for things that we have seen a lot of progress, like the deployment of renewable energy, we're not on pace to meet these, closer term 2030 targets, which gives you a sense of foreboding about these, very big targets that lurk beyond that, such as getting to net zero by 2050, which is, what the goal of the Paris Agreement was.
So why aren't we getting closer towards those 2030 targets, and what would it take to triple renewable capacity?
So, that's one of the better news stories. I mean, anyone who's been following or just looking around notices that there's a lot more solar happening and a lot more wind, especially in parts of Europe and in China, and, solar panels everywhere. It's just not quite at the speed that we would need to reach that tripling goal. So, especially with the huge amount of solar coming out of China lately, we're seeing enormous gains there, but getting to the tripling by 2030 is going to take more, and we're especially not seeing like an equal distribution of these things all throughout poorer economies, and that's one of the topics for debate here at COP. There's a need to deploy more climate finance to make it possible for countries that don't have a lot of energy at all right now, and especially a lot of renewable energy, to be able to afford solar power and wind power and other technologies like that. And that's, one of the problems that's holding back this goal of tripling. If you look at some other metrics, things get even worse. So if you look at, say, the deforestation target for 2030, the 130 countries in the world that account for 90% of the world's forest land have agreed to halt and reverse deforestation by 2030. Instead, we're seeing deforestation actually increase right now.
Hey, Aaron, what's the feeling there at the conference about the presidential election and what's happened here in the U.S. in terms of the U.S. elections?
It's been the big talking point for people all in the hallways of COP. This was a big change that came just days before 200 countries gathered here. And there's no doubt that change to return to the Trump administration, which famously pulled out of the Paris Agreement and sort of really reduced American cooperation on climate, is going to hold back progress even further. So that's one of the things that kind of informed our desire to do this story. We might be kind of seeing right now about as fast as we can go, because if you take the world's biggest economy and the world's second biggest source of greenhouse gas emissions out of the equation, it might not mean that the energy transition is over, but it certainly is going to hold back any attempt to go faster than we're going right now.
Aaron, thank you so much for joining us. Really appreciate you taking the time. Aaron Rutkoff. He is the executive editor for Bloomberg Green, joining us via Zoom from the COP29 UN Climate Summit that's taking place in Baku, Azerbaijan. And so we appreciate him staying up later in his day to bring us the big take story here. And you can read more of this story on the Bloomberg terminal and at bloomberg.com/big take. And I can't believe the folks over at the COP29 conference are too pleased about what's happening in the election here in the U.S.
Yeah, it's going to be a big thing, especially if they're already behind those 2030 targets, Paul.
Exactly right. All right, S&P 500 off 13 points, the Dow off 175, NASDAQ off 30 points here. So we will have more coming up for you. Bitcoin, 86,000. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all in the red right now. We are looking at a 12-point drop on the S&P 500 index, back below 6,059.89 where we stand right now, lower by 0.2%. That rally running out of steam today with the Dow down 188, retreating by 0.4%. NASDAQ Composite Index down now by 0.1% with the 10-year at 4.39%, the 2-year 4.31%. 0.31%. Spot gold down $16 the ounce, down 0.6%. West Texas Intermediate crude lower, little change now, down 0.1%, and a 2% drop right now for Bitcoin, back at 86,197. CEO of ExxonMobil, Darren Woods, is discouraging President-elect Donald Trump from withdrawing the U.S. from the landmark Paris Climate Pact, arguing that it would mean forfeiting a chance to push for, quote, common sense carbon-cutting policy on the world stage. Right now, we've got ExxonMobil shares down by 0.4%. Oil and oil stocks lower. OPEC cutting its oil demand growth forecast for this year and next for a fourth consecutive month as it belatedly recognizes a slowdown in top consumer China. Again, shares of ExxonMobil, as I mentioned, down 0.5%. BP now down by 3%. And Chevron lower by 0.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, where